for the Fed here. I do think that they're seeing enough in those inflation readings that will get them to a cut in June.
There's a reasonable risk that they don't cut this year. If you get more of these inflation numbers similar to January, then I think those risks increase.
The start of cuts is not about easing, it's about normalizing, and inflation is what's key.
If you boil things down, the US economy continues to do really well. Inflation is slowing down.
The data needs to confirm we get to 2% or lower before we can cut rates. You need to get ahead of disinflation, leave everything on the table.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is CPI Tuesday, live from New York City this morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market on the S&P 500 positive by 0.2% on the S&P. Chairman Powell would like a little bit more data. He'll get a little bit more a little bit later. Going into the Federal Reserve meeting next week, will he have sufficient evidence to change his call, his view on this economy?
People are really looking at this CPI report as being one of the most important in the past couple of years, which is what we hear every single time. But this time we hear it more often. And basically the options are setting up to really have more volatility on the heels of it. The idea here is if you see another hotter than expected CPI print, you will get a material move in markets where you start to reprice out the Federal Reserve, where they cannot cut rates well after June.
Just like going into payrolls on Friday, the question is exactly the same. The question on Wall Street has not changed. Was the upside surprise in January a one-off or not? Bloomberg Economics have this to say, AMH, this morning. We don't expect the February CPI report to provide clear enough evidence of disinflation to boost the Fed's confidence to cut interest rates. This is about how we set up that meeting going into next week.
So potentially they're going to need more data. What I extrapolated, though, interesting enough, from the Biden budget yesterday, which I find just to be a political document, was actually how they view inflation averaging the rest of the year. It's at 2.9%. So when we sit here and talk about stabilization of inflation, the Fed is going to get closer to 3% or their target of 2%. The White House is actually more pessimistic than even our own economists we surveyed.
This is the outlook for the Federal Reserve. Can we talk about the BOJ as well? Yeah. Another story on the BOJ. I just feel like we're going to be doing this every single day going into the Bank of Japan meeting next week. Dollar yen this morning, 147.44. According to people familiar with the matter, it could come as soon as next week. The first interest rate hike since 2007, Lisa. And going back to what we've said over the last 24 hours, it will come down to what those wage negotiations look like on Friday.
Given the fact that we have seen pretty rapid pace of wage increases at the recent labor negotiations, I thought this latest piece of reporting was sort of pushing back a little bit, given that the outcome was too close to call, considering that markets basically saying that this is a done deal. To me, the question ultimately is, do they have a path to walk through, and how much does the Bank of Japan depend in some ways on the CPI print and what that means for the Federal Reserve?
It's so true. We could get the first hike from the BOJ since 2007, and the cut we've all been waiting for from the Federal Reserve just seemed to be pushed back over the last couple of months. I want to talk about TikTok as well. Lots of talk down in Washington, D.C. This is the number 2 Republican, Steve Scalise, on whether this bill is going to pass on Wednesday. Quote, Annmarie, yes, it will. Some opposition from the former President Donald Trump. It does not look like that's going to shape votes in the House in a material way.
Looks like it's going to sail through the House as it sailed through that committee, and then it's set up for the Senate. And what do they do when it gets to the Senate floor? Does Schumer put it actually on the Senate floor? Biden says if it passes Congress, even though his campaign is currently using it, he said he will sign this bill. And then it's off to the races. A lot of people I talked to, Jonathan, are talking about the fact that they don't actually see a ban. They just see someone else taking it over. And potentially that would mean a safer TikTok in the eyes of regulators and officials.
So here's the former President Trump. This is what he had to say. Frankly, there are a lot of people on TikTok that love it. There are a lot of young kids on TikTok who will go crazy without it. There's a lot of good and there's a lot of bad with TikTok. But the thing I don't like is that without TikTok, you make Facebook bigger. And I consider Facebook to be an enemy of the people, along with a lot of the media. So that's his view.
Some people might share that view. Let's park TikTok. Let's park the former President Donald Trump. Let's approach this story like this. Any other story, if we conclude that it poses a national security risk, and there are politicians down in Washington that are unwilling to protect people from a national security risk, we'd all be sitting here, arms in the air, saying, what on earth are they doing? So I think we should all be doing that regardless. What on earth are they doing in Washington, D.C., and what does it tell you about the state of the nation's capital? That they have all concluded that this could pose a national security risk. The sitting president is campaigning on it, and there are people down in Washington considering not to pass a bill that would protect you from it. That's kind of bizarre to me.
If you wonder why Washington, D.C. has lost some credibility, there is a real question. If it is national security, show us all of the evidence and then do something about it. If it's not, well, then take a laissez-faire attitude toward it.
Well, all we need to look at is what happened yesterday in terms of an intel hearing with Christopher Wray, the FBI director, talking yet again that this is a national security threat. And also, we had the global report on national threats, and they mentioned TikTok specifically playing politics in the United States midterm elections. Now, if you're an elected official and you read this report through and through, there's obvious concerns. But, Jonathan, on the right, some of this has to do with money and campaign donations. And I think on the left, it has to do with making sure you're reaching that youth vote.
Without a doubt, it's about pleasing the kids and making sure you get money. It's bottom line, that's it. That's Washington. That's why people cannot stand what happens in the nation's capital, Lisa. That's what it comes down to.
Pleasing kids and getting money?
I mean, it makes no sense at all.
It's like
Think about it. Let's go through it again. You are facing a national security risk and you are worried about what the kids might say. I mean, are you serious? Are you serious?
Well,
is that the state of things?
That is the state of things, yes. Are you actually surprised? Come on. Are you actually feigning surprise right now?
No, I'm not. But if you're wondering why people get frustrated with politicians, wonder no more. This is it.
I don't think anyone was wondering.
Well,
I'm just letting you know.
Well, Shou Chew, the CEO of TikTok, is going to be on the Hill this week. He's obviously having a grueling week. But yet again, if this is not banned and a U.S. company takes it over, then the 150 million users it has and being the #1 news source for Gen Z may still exist. So they may potentially be able to save the kids. I'm not sure what this means for some Republican donors. But to your point, Jonathan, Washington may actually act this week. Let's see Wednesday. Steve Scalise says it has the votes.
That's 2 minutes too many on TikTok. Let's move on. Equity futures on the S&P 500 positive by 0.2%. It is CPI Tuesday, a morning full of inflation conversation. Yield to lower by a single basis point on a 10-year, 4.08%. In foreign exchange, the euro unchanged, 109.28. Coming up this hour, Brian Levitt of Invesco with investors awaiting the latest CPI print. John Lieber of Eurasia Group as tensions between President Biden and Israeli Prime Minister Benjamin Netanyahu ramp up. And Nita Richardson of ADP on the impact of housing and labour on today's inflation data. We begin with our top story, counting you down to CPI at 8:30 Eastern Time. Brian Levitt of Invesco looking for disinflationary trends to stick, saying this: the risk at this point in the cycle would be a meaningful deterioration in economic growth that we are not forecasting. A re-acceleration of inflation would not be on the top of my list of risks for 2024. Brian joins us now for more. Brian, good to see you. Let's just start with the data that drops at 8:30 Eastern Time. What are you and the team looking for?
So I think inflation, even though what I said there, inflation is moving up a little bit if you look at the momentum. But the good news is it's really not coming from the consumer. It's really not coming from wages. You're seeing it more on the import side, which, of course, is what's happening in the commodities space. So you might get a little bit of a stronger than expected inflation number today. But I'm not extrapolating that out to being we're heading back to where we were. This is extremely problematic. It seems like every cycle we go through, including 07, right? Let's remember that, including 2007, there's another head fake on inflation. Ultimately, the lagged effects of policy tightening start to hit.
The obsession today is about shaping the Federal Reserve decision of tomorrow.
Yeah.
For you don't seem to be dependent at all on how many times they cut this year.
Yeah, I'm not overly concerned about the number of cuts. Now, there is some nuance with regard to market leadership, but my North Star has been, and it's been for the last 15 months, is that the markets do very well after the peak in inflation, after the peak in tightening. Now, the nuance around how many cuts you're going to get, when the market initially priced in 6 cuts, which was sort of strange in hindsight, in November and December, huge small cap rally, huge mid-cap rally. Now that you're backing some of that out, the market became a little bit more concentrated. So there's that nuance. But ultimately, after what we went through, I'm just happy that tightening's over. And over the next year, we're going to normalize the yield curve.
My favorite part about this cycle is that even the people who sort of sound bearish are actually bullish. It sort of depends on your time frame, that people who see a short-term sell-off see that as a reason to buy, and that long-term, there's a real positivity there. Do you count yourselves among them? You might not be FOMO anymore, but if there's a 5 to 10% pullback, you're all in.
Yeah, I'm all in. I mean, there's a 5 to 10% pullback every year. right? And so this year is likely to be no different. And when do those pullbacks come? They don't emerge out of nowhere. They're almost always the result of policy uncertainty. So if you get a couple of unexpectedly strong inflation numbers, well, that'll be a catalyst for some type of pullback. Remember, we've had an incredible start to the year, and so you should expect some of that. But ultimately, you have to ask yourself, are we on a path towards policy normalization following, 525 basis points of interest rate increases? Ultimately, that's where we're heading, and that's a positive.
All right, I just want to understand the playbook here. BNP Paribas agrees with you, since the key risk event really is the CPI print, and saying a stronger than expected print would challenge our pro-risk bias, talking about this across-the-board retracement. Where do you think gets most punished if we get a hotter than expected CPI print today?
Well, you're going to see some pain in the bond market. You're going to see some pain in small caps, in mid caps. So really more of that cyclical trade, really more of that. We're finally coming out of this COVID environment. We're finally going to be able to lower rates, finally be able to normalize the yield curve. I think investors will shift back to, not shift back, will remain in the highest quality mega cap names, if that's the case.
I haven't heard that word COVID for a long, long time.
We're
finally making our way out of that COVID environment. You think we've still been stuck in it?
We're stuck in it, not from the sense that we're all living in our basements anymore, and it's nice to be here on set with all of you after so many years. But when I mean the COVID environment, is it's been such a strange 4 years. The only reason we got inflation is because we put so much money in people's pockets, and businesses had cut workers, slashed inventory at the worst time. So then you have to raise interest rates. You've got to get a growth scare, because every time the Fed raises rates, you get a growth scare. The markets fall 25%. And now we're coming out of it. We've been coming out of that environment, but it's still is it a soft landing? Is it a hard landing? So until we know what that landing looks like, until we normalize the yield curve, that's still moving our way out of this bizarre COVID environment.
But people no longer have that money in their pockets from the government, and we haven't seen the supply chain bottlenecks repeat themselves.
Right.
So what's left?
Not a lot. Yeah, I agree with that. And so what you're dealing with is there are some sticky components of it, but what's really been driving the consumer price index is shelter. Shelter, the way it's calculated, comes in with a lag. I mean, the owner's equivalent rent that nobody actually pays continues to drive this. And so you see this in every cycle, that it lags. The Fed says they're going to be data dependent, but we should be looking out to the future.
Sounds like you've got some questions about the data they're dependent on.
Yeah, a little bit. I do have some questions about it. And ultimately, we're going to have a two-handle year over year on CPI. I mean, we're very close. The Fed's preferred measure, the core personal consumption expenditure year over year, is already there. So I think inflation is a story of the past. You may have some hiccups here in the short term that could create some near-term volatility. But over the next year or two, I'm sticking with peak inflation, peak tightening, peak rates as being very good for risk.
I know who else has got some questions. Bramo. Just see Bramo out the corner of my eye with some real questions.
Well, I love this. Data dependency, and the data is unclear and messy, and I don't really trust it. So
wasn't that a description of Friday?
Basically, what do you do with that? And that's basically what we've been on repeat. I mean, I was reading report after report saying that the people are not responding to the surveys for unemployment reports and for jobless claims and for jobs, for the non-farm payrolls report. You're not getting responses, so then you're extrapolating out into a void.
Look at the revisions on Friday, massive revisions. Can we finish on that? How dependent are you on the economic data, given how perhaps there are questions about how dependable it actually is?
Well, we look at leading indicators, and so you don't want to be too focused on things that lag. You will focus on the leading indicators where we continue to believe in the data, real data points or survey data that points to the future. And what it's been suggesting is a global economy that's below trend. I think that's reasonable. Market sentiment has been suggesting, maybe things pick up a little bit here. But I would still call it a below-trend environment that the Fed is likely going to ease into.
OK. Brian Levitt of Invesco sticking with us. Self-described FOMO guy. He's going to be with us for another segment. Equity futures on the S&P positive by 0.2%. Here's an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Bank of America disclosed pay raises of more than 10% for two of its highest-ranking executives, even as its CEO, Brian Moynihan's compensation was cut for 2023. CFO Alistair Borthwick's total pay climbed 14% to $12 million last year, while Jim DeMare, head of the bank's Global Markets division saw a rise of 11% to $21 million. Meanwhile, Moynihan's pay was cut by 3% to $29 million in 2023. A bill that would force the sale of TikTok is gaining steam in the House. The legislation would block app stores and internet service providers from offering the video sharing app, unless its Chinese owner ByteDance sells it within 6 months. FBI Director Christopher Wray told a Senate Intelligence Committee there are, quote, significant national security concerns associated with TikTok. The bill comes up for a vote in the House tomorrow. The cocoa rally is showing little signs of slowing, futures climbing as bean shipments from the Ivory Coast came in far below last year's level. New York futures rising as much as 4%, erasing losses from the previous 2 sessions and pointing to a tighter global market. The risk of lower output from the smaller mid-crop harvest has added steam to the rally, which has seen the price of cocoa jump by almost 60% this year. That's your Bloomberg Brief. John?
Yahara, thank you. We'll catch up with you a little bit later. Up next on the program, division among allies.
I'm telling you that we're not getting off the gas. I'm telling you that we have to take care of Israel's security and our future, and that requires eliminating the terrorist army. That's a prerequisite for victory.
That conversation coming up next, live from New York City this morning. Good morning. Two hours away from the CPI report, equity futures positive by 0.2% on the S&P 500. 10-year yields a little bit lower, down about a basis point, 4.09%. Under surveillance this morning, division among allies.
I'm telling you that we're not getting off the gas. I'm telling you that we have to take care of Israel's security and our future, and that requires eliminating the terrorist army. That's a prerequisite for victory. Victory will come as soon as, I think it will come sooner, the more united we are, not divided, or at least not given the appearance of division.
Here's the latest. Tensions rising between President Biden and Israeli Prime Minister Benjamin Netanyahu amid the rising civilian death toll in Gaza. Netanyahu not expected to change course as President Biden calls a planned attack on Rafah a red line. John Lieber of Eurasia Group writing this. President Biden's comments are the clearest reflection to date of a growing divide between the US and Israel and leave Biden painted into a corner with his domestic political audience if Israel moves forward with operations in Rafah. John Lieber joins us now for more. John, I want to talk about that red line and I want to talk about the policy potential behind the threat. What happens if Netanyahu does cross that line that the president has set?
I think what you get is a mostly symbolic cutback in some of the more high-profile offensive arms that the U.S. is sending over to Israel. Biden was very explicit when talking about the red line that he would not be cutting things like the Iron Dome, that he believed Israel still had a right to defend himself. But this situation reflects a real challenge for President Biden. He needs to look like he's getting tougher on Benjamin Netanyahu because of his own domestic political concerns. You've got a lot of blowback against the U.S. support for Israel in the United States, and particularly among Biden's Democratic base. So this tension that you're seeing is a really difficult balancing act for President Biden to both say Israel has a right to defend itself and that Israel cannot trigger yet another humanitarian crisis in Gaza.
A recent poll showed that a sizable majority of his voters oppose weapon shipments to Israel. When he spoke and gave that interview, could you see the White House saying, we prefer things like the Iron Dome to protect Israeli civilians, but we might ratchet back some of the offensive weapons we give to Israel?
Yeah, it's that might ratchet back issue that I think is the biggest question, because there's a lot of Americans who want Israel to continue to push the offensive against Hamas and to win this war. And a lot of those Americans are going to be voting for Joe Biden in November. So I don't think there's a ton of room for the U.S. here to condition aid. You may see some efforts to do so, assuming this Rafah operation goes ahead, and we assume the Rafah operation will go ahead. But, Israel's doing this with or without Biden. It doesn't seem like the pressure the United States is putting on them is making any difference whatsoever. And I think that's a meaningful aspect of this as well. It sort of shows the limits of even the United States' power and influence over Israel to press this offensive.
The president of Cyprus tweeted just a few hours ago that the first ship has set to go to this Gaza port they're building for aid. Will that assuage Biden voters?
It's a step in the right direction. I think that really the aid, building a port, getting more aid into the country is going to be a significantly smaller piece than the images of the offensive in Rafah, assuming it goes ahead. And that's really what's getting Biden right now. Is you've got this massive humanitarian crisis in Gaza. Aid is not going to help when you've got orphan children and images of dead families that are crossing across American social media. And that's really the political vulnerability that's going to hurt Biden here. The aid is only a tiny push in the other direction, I think.
I want to shift gears a little bit. This is definitely going to be a massive issue for President Biden with respect to his voter base. Another massive issue is going to be some of the trade policies that we have going into the election. We've heard from former President Trump yesterday that he said, I'm a big believer in tariffs, and that if he does impose 60% tariffs on Chinese goods and they retaliate by doing the same, he doesn't care. He welcomes it. This is basically his policy. How much is this signal and how much is this noise?
Yeah, that's pretty good locker room talk. But I think if you look at the U.S. reliance on imports from China, it's really difficult to imagine the U.S. economy without all the consumer goods that are coming into China. I mean, look, the iPhone the latest model already cost $1,000. Imagine that price going up to $1,600. This is the most popular phone in the United States of America. I think that's a really big hit for consumers. And it just seems really unlikely to me that Trump can follow through on such an aggressive threat. Now, that said, that threat can be used to open some kind of negotiation, which is exactly what President Trump did in the first administration in order to get to what eventually could become a phase 2 trade deal. And I don't think we're predicting that just yet. It's really early days. Trump does seem, and the Republican Party is moved in a more hawkish direction on China, where full decoupling is more of a policy goal, but the actual practical impacts of that on the ground for the American people make the political costs of that extremely high, and therefore probably make that 60% threat unrealistic.
Hey, John, great to get up to date with you on what's happening down in D.C. John, leave it there. If you raise your group, some insight into the locker room talk of Mar-a-Lago. Maybe it's stuff they talk about down there.
I'm a big believer in
doubt
tariffs.
it.
I mean,
I doubt
maybe.
it. Brian Levitt, are you a FOMO guy if a new president comes through with 60% tariffs?
Look, I mean, my point on tariffs has been that anytime you protect trade or anytime there's protectionism, there is less optimal economic outcomes. It's just how it goes. But in terms of the market really just needs clarity. If you remember 2018 was a year in which we just didn't have clarity around trade policy. We ended up with business investment drying up pretty significantly, a 20% downturn at the end of the year. The tariffs did come through, but ultimately that clarity pushed the markets higher in 2019. So less optimal economic outcomes, but so long as we have clarity around it, then the markets tend to be able to push past it.
Which is one of the reasons why I've been confused about whether the lack of clarity on who's going to lead the United States after November, has that led to more deals getting brought forward, or has that led to fewer deals that are basically being put on hold until more certainty comes to the fore?
Well, it seems as if they're being put on hold right now until there's more certainty that comes to the fore. But what I always advise investors not to put too much onus on elections. I know it becomes a lot of focus in the election years. If you go back over time, you find that market performance is fairly similar across most administrations. In fact, if you go back to the Eisenhower administration when the S&P 500 came out in '57, every president had a positive return over the course of their administrations, but two. That was George W. Bush, whose term ended in the global financial crisis, and Richard Nixon, whose term ended in the 73-74 recession. So other than that, not only are they all positive, they're all double digits. They're all 10% per year on average, which is a double every 7.2 years.
Brian, it's good to see you, as always. Brian Levitt of Invesco. We'll be catching up with David Kelly of JP Morgan Asset Management a little bit later this morning. Great piece, interview with him in Barron's. I worry that people worry too much about politics. I worry that people let how they feel about politics affect how they think about investing. There are a lot of Republicans who missed out on a good stock market under Obama and Biden, a lot of Democrats who missed out on a great stock market under Donald Trump. More on that a little bit later. Coming up, Jeremy Stretch of CIBC on bets the BOJ will hike next week. It's not just the Federal Reserve meeting next week. We might get the first hike from the BOJ since 2007. From New York, this is Bloomberg. Two-day losing streak on the S&P 500 coming into CPI. Equity futures trying to bounce this morning, up by 0.25% on the S&P. On the Nasdaq, up by 0.5%. It really has been super mild stuff over the last couple of days. In many ways, the week begins in about 2 hours' time when we get that CPI report. The scores in the bond market look like this going into that 2-year, 10-year, 30-year. The 10-year, a couple of Tuesdays ago, 4.30. Now back down to about 4.1% on a 2-year yield, 4.53. That was north of 4.70 a few Mondays ago. Yields have dropped away, Lisa, in quite a significant way in the last couple of weeks.
Which is the reason why I can't wait until 1 p.m. today. Yes, the news starts in about 2 hours, but we get auctions. We get a $39 billion of 10-year notes sold today. And do we get the same kind of demand coming to the fore after yields have come in so dramatically, given that people are saying, I don't buy it. The growth is still pretty good.
Earl Davis of BMO coming up a little bit later on the programme. He was looking for a backup in the long end. We'll talk to him. If he's still looking for that, we'll find out a little bit later. I want to finish on foreign exchange. Can talk about the Japanese yen. We'll do that in a moment. I want to talk about sterling as well. Sterling a little bit weaker, negative by 0.2%, 127.91. I'm looking to the labour market data from earlier this morning. Lisa, looking at unemployment, just a little bit higher. Wage growth, just a little bit softer.
Basically, you see a labour market cooling that's positive for the Bank of England and their ability to potentially cut rates, but raising questions about just how strong this economy is. So on a certain level, is this good or bad for the currency, right? If they cut rates sooner, OK, a little bit of weakening, but it comes along with weaker growth as well. The
pound, 127.92. Under surveillance this morning, 2 hours away from CPI. Bloomberg Economics expecting headline data to accelerate 0.4% month on month, with core slowing down a touch. Higher gasoline prices putting pressure on the inflation read, rising over 9% year to date. The team at Bloomberg also expecting the bulk of disinflation to come from core goods, led by an easing in new and used car prices. I go back to the payrolls conversation again, Lisa. Will it confirm the upside surprise of the first month of this year?
That's what a lot of people are looking for. If it does, I'm actually curious to speak to Stuart Kaiser later this morning, because he's talking about how the options positioning means that it could potentially be a pretty significant response one way or another. With, BNP says a huge strengthening in the dollar, a sell-off in risk assets. How much is this the catalyst for the sell-off people have been waiting for?
Jonathan, you mentioned Bloomberg Intelligence looking at not just rental costs, but also gasoline. It is up 3.5%. Prior, it was in a negative reading, and Bloomberg Intelligence says we forecast energy costs added 15 basis points to the monthly headline print. This was the sticky inflation that the Fed really was trying to deal with. And also, this could be a massive headache, not just for Jay Powell, but President Joe Biden.
Just to share those estimates with you, in our Bloomberg survey, the median estimate 0.4% month over month, from 0.3 in a previous month. If you strip out food and energy, 0.3% is the estimate, down just a touch from 0.4% the previous month. Would you like a weather forecast on the economy from Jamie Dimon, the CEO of JP Morgan, saying this: a US recession is not off the table. Speaking at the Australian Financial Business Review Summit, Dimon adding, quote, the world is pricing in a soft landing at probably 70 to 80%. I think the chance of a soft landing in the next year or two is half that. The worst case would be stagflation. The comments mark a change of view from Dimon's warning that a hurricane was about to hit the US economy as the Fed was kicking off the hiking cycle 2 years ago. Bramo, your thoughts?
I can't keep track. I mean, this is someone who also is talking about 7% rates. He's also talking about the potential that the Fed should keep rates high because of concerns about stagflation. Meanwhile, two of his JP Morgan analysts are warring. You have Miro Mayetka, and you've got, of course, Marko Kolanovic, both coming out completely opposite views. Marco saying we're going to have a problem. Watch for the sell-off. The sky is falling. And meanwhile, on the other side, tech earnings have been so strong that these stocks could still hold out better than traditional cyclicals. So do you pay attention to the boss? Do you pay attention to one side of the house? Do you pay attention to the another?
Yeah.
You know, maybe just check
I've got
the
things
weather.
to say. Can we take 60 seconds?
Yeah, please go.
I'm frustrated by the way people interview him, as if he is a South Side economist who's going to give his base case on what's going to happen with the economy. And in those comments overnight, he actually says it himself. When you run a business, you're not operating on a base case. You've got to manage risk across the spectrum. So they need this business to do well, whatever the weather. And I always find it really frustrating when they're like, how many times are we going to get cuts this year? How many cuts do you think we're going to get? I mean, what kind of insight is he going to have on that versus anyone else? What you really want to be asking, you've got a massive business, insight on the consumer, on business, on policy, what it means for your business, what this would mean. Go through some scenario analysis. But sitting here saying, you know, stick your finger in the air, you know, like, what's the weather forecast today?
Yeah.
I find it really frustrating.
You know, you could ask, you know, if you were going to be in the seat to run, you know, chief commander of the United States, would you argue for the Fed to potentially cut rates or to hold them where they are? If you were going to go into politics and are making these prognostications for that reason, then would you do so sooner than later? That might be what they're trying to get at.
When I constantly hear him talk and pontificate, I always think it's not POTUS that he wants. I think he wants Treasury of the Secretary. And I felt this way at Davos when he talked about that. He said Trump had a few things right when it came to taxes, immigration, China, and NATO, and potentially was auditioning and now throwing some cold water on a soft landing, even though he previously said it was a hurricane. You have to wonder, Jonathan, yet again, is he maybe auditioning for Treasury Secretary?
A diamond off the table. I can see why anyone with a lot of stock would find it interesting going down to Washington, D.C., taking a government job and being able to sell that stock tax-free.
I know what you think.
Diamond off the table. I'm just talking about anyone who might be interested in making that
Is Diamond
move.
completely off the table with that discussion?
We can talk about people who have done that and have actually got that benefit from doing so.
But that might be one of the motivations.
I'm not saying it's his motivation. I don't know, because I'm not in the business of getting people's heads, and we can ask him directly if we ever get the opportunity. I'm just saying that in the past, people might have done that.
Yeah, it's
and
true.
I can see why people would be interested in doing so.
I just keep thinking about Libby Cantrell, that she has to go around being like, he's not running for president, because people are still thinking that maybe he might be.
Libby was great, wasn't she?
She's great.
She'll be coming back soon, no doubt. Equities right now are just about positive by 0.2%. I did mention in the foreign exchange market that we talk about the Japanese yen, so let's do that. BOJ Governor Ueda expecting growth in Japan to continue despite some weakness in household spending. Ueda answering questions from Parliament as traders pass every comment ahead of the decision a week from today. Bloomberg survey showing a slim majority expect the first hike to come in April. Still, officials and investors are waiting on the results of spring wage talks, which will offer results on Friday. Jeremy Stretch of CIBC joins us now for more. Jeremy, let's get straight into it. Expectations for next week. What are yours?
Well, we've long held from CIBC perspective that we anticipated the rate hike coming in April, but clearly the speculation is not without some degree of foundation. I think it may be a case that some of the more hawkish members of the BOJ are perhaps trying to bounce the decision into a rate adjustment next week. But I think probably on balance, we'd still feel comfortable looking at April, because after all, when you think about the period between the April and March meetings, you're only talking about a 38-day wait for what is effectively a 10 basis point move. So in a sense, I think it's prudent perhaps for the BOJ to wait for the full and final information regarding the wage round. But clearly, investors are very nervous going into next week's decision.
Jeremy, we've got to move on dollar yen. We're down from 150 back to 147. Some yen strength we haven't seen in quite a while. Can you talk to me about what the road looks like towards sustainable, durable yen strength, and why maybe a couple of rate hikes might not be sufficient?
Well, I think what we have to remember that if we look at this particular move in dollar yen over the course of the last couple of weeks, it actually is probably more a function of the fact of what's been happening in the US Treasury space and in terms of US yields, rather than necessarily purely driven by presumptions or expectations of an adjustment in terms of BOJ policy, as I say, of a mere 10 basis points. But having said that, if we are going to see a more durable yen rebound, then we do need to see the BOJ adjusting policy, so allowing yields to continue to move higher and looking at a higher level of front-end rate. And I think also we need to see a squeezing out of what is still a very sizable short position in terms of real money yen players. So I think there is scope for adjustment, and I think it's interesting that we're debating this process of the BOJ looking towards its first hike at the same time as even next week we could be considering a bank moving in the opposite direction in the context of the S&B. So I think there's certainly something to play for in terms of some of those previously low-yielding currencies.
How much, Jeremy, do you think that the decision for the Bank of Japan hinges in some ways on today's CPI report based on the fact that it's looking for a window to execute this with the least volatility?
Well, I think that's absolutely true. I think that all roads inevitably and almost inexorably always lead back to the US story and what's happening in terms of US macro and also, more importantly, in Fed dynamics. So I think there is going to be a substantial reaction function in terms of a CPI miss, whether it be both to the upside or to the downside today, although I think probably more aggressive risk if there were to be another upside surprise in terms of CPI. But I think if we do get a degree of sort of benign narrative coming out from the CPI print, and of course we shouldn't lose sight of the fact we've also got that retail number on Thursday, which I think is also potentially quite impactful for the Fed narrative. But if we do see this presumption of just that generalized moderation in price pressures in the US and leaving open the prospect of Fed easing to come as early as June, although that's not our base case at CIBC, we're looking for July. But if the market continues to feel comfortable pricing June, then that might provide some degree of scope for a benign backdrop, which would open the door for the BOJ.
A bit of a shaky line on your end, or maybe even our end, Jeremy. So we're going to go. It's great to catch up ahead of the BOJ next week. Jeremy Stretch there of CIBC on dollar yen and all things Bank of Japan. I want to talk about a single name. Southwest in a pre-market, negative right now by a little more than 8%. An update from them. They plan to cut 2024 capacity, citing the challenges with Boeing. We had warnings about this from other airlines, including Ryanair in Europe. And Lisa, you're seeing it right now from Southwest.
Yeah, and you can see those shares lower by more than 8%. Less capacity means potentially lower revenues. On the flip side, from Alaska Air, we saw overnight that they actually had a little bit better profit margins just simply because they weren't paying as much for some of the Boeing planes. I am curious, though, how this shakes out, especially given some of the new disclosures overnight that Boeing failed a whole host of different investigations post the blowout that we heard about, and that there's some real concerns about their safety protocol. How do they claw out of this when every single day it's tick by tick by tick we get some more additional negative information?
This is having a real business impact, reevaluating all prior full year 2024 guidance, plans to cut capacity, Annmarie, citing these challenges, and re-optimise schedules as well.
Yeah, assumes no 737 aircraft deliveries. So that completely recalibrates Southwest for the rest of the year. And Lisa, to your point, this tick by tick from Boeing, Washington Post reporting yesterday, then we also added on top of that, the Justice Department has now convened a grand jury as part of that criminal investigation. So that means that it's going to open up the ability, subpoenas for interviews and documents. So we are going to see a lot more of what is going on behind the scenes of Boeing from the factory floor, Jonathan, to the C-suite.
Just another note on Southwest Air. They're still making the point that they expect to return to profitability in March. And this is a classic example of a business maybe planning for the worst case and not the base case. Boeing has told them, advised the company, according to Southwest, to expect 46 737-8 deliveries. And there's a company, Bramo, basically planning, as Annmarie said, to assume no deliveries whatsoever.
And they're planning for the worst because they've already been through some real disappointments to the market, and they don't want to do that again. They're trying to claw out of that disastrous winter holiday season. Remember that, when everybody's planes got canceled? Southwest is fascinating to me also because they hinge more on domestic travel, in particular having to do with vacations. So they're kind of a great read on a lot of things. The fact that they're assuming the worst might mean that there's a lot of positivity elsewhere.
An update on the stock in the pre-market. We're negative here by a little more than 8%. We'll keep one eye on that story throughout this morning. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. 4 astronauts from 4 countries have touched down on Earth after a half-year mission aboard the International Space Station. SpaceX's Dragon capsule splashed down in the Gulf of Mexico near the Florida Panhandle in the early hours this morning. The so-called Crew 7 moved into the space station last August. The replacements arrived last week in their own SpaceX capsule. Oracle shares are on track for their biggest rise in more than 2 years as the company sees a spike in bookings for its cloud computing business. The stock had been down about 10% over the last 6 months through Monday's close. Oracle, which is known for its database software, is now focused on expanding its cloud business to compete with the likes of Amazon, Microsoft, and Alphabet. The FDA has approved weight loss drug Wegovy for heart disease patients, a move that could open the door for Medicare coverage since it raises the question of whether Medicare could now cover the cost for patients with a history of heart disease. About a third of state Medicaid programs currently cover the use of Wegovy and other GLP-1 drugs for weight loss. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, targeting 2% inflation.
I do think that they're seeing enough in those inflation readings that we'll get them to a cut in June. Let's say retail sales is weaker, we have a softer inflation report, then I think we'll start pricing that May cut again.
That conversation just around the corner, live from New York. This is Bloomberg. Breaking news on Southwest, planning to cut 2024 capacity, citing challenges with Boeing. A new assumption, now assuming no 737-7 aircraft deliveries. The stock is down, Lisa, almost 7%.
Also talks about not hiring for a number of different types of groups, including pilots and flight attendants. Again, this really raises questions about where they're going to be flying, how they're going to be flying, and how much this is really going to reduce their profitability after already going through a really difficult period of time.
We'll keep returning to that story, the broader story for you. Equity futures hanging in, doing okay. We're positive by a third of 1%. Under surveillance this morning, inflation data on deck.
I think we're in a scenario that we haven't really experienced in decades, in a sense, in that we have inflation that's running above target, and we will have this emerging weakness in the activity data. I do think that they're seeing enough in those inflation readings that we'll get them to a cut in June. Let's say retail sales is weaker, we have a softer inflation report, then I think we'll start pricing that May cut again.
Here's the latest. Less than 2 hours away from February CPI, the median estimate from Bloomberg survey calling for a headline print of 0.4% month over month, slightly higher than last month's hotter than expected data. Nina Richardson of ADP writing, quote, "My view is that inflation will continue to decline to a point, and that point may be as difficult for the Fed to maintain as it was to reach." Nina joins us now for more. Nina, great to see you. Let's get into that. This is about housing and the labour market. Can we get to housing first? What is it about housing that you think is going to make this path to 2% difficult?
It's the Achilles heel. It's the juggernaut on the way to inflation. Why? Well, because we are in a classic inventory shortage that's been chronic for the last decade. That's not cyclical and it's not going away. And people have to live someplace. It's not something they can avoid. And so if you have a for sale market that's challenged with inventory, that challenges the rental market, especially in key cities. And you see that play out over and over again. It's also the biggest part of the consumer budget, a third, of a lot of people's actual consumer budget. So it plays out in terms of inflation. It's a really big issue for the Fed. It's hard for them to get around.
It's hard for us to understand as well. Net, have higher rates boosted prices or held them back? Which one is it if it's a supply-side story?
Here's the problem with economics. There's two sides of every market. So interest rates may hold back demand. It also holds back supply. It's costlier now to build a house. And then you have to think the construction workers, which are also now more expensive because wages have gotten up. Labor shortages are there. And so you have both sides of that market struggling under higher interest rates. Who wins? Well, what I've seen for, too long to quote on television, in the housing market as a watcher, is that home buyers do pull back for higher interest rates, and then they go back in. They test the temperature. Okay, it's a little hotter than I expected, but then they'll go back in because at the end of the day, the house is the goal.
Well, Neela, exactly for that reason, how much do you think that some of the easier monetary policy baked into market expectations, how much has that already supported a reigniting of some of the valuations in the housing market? How much is that already making things more expensive?
Housing wealth has been incredible since the pandemic. If you look at house prices, they've gone up, but home equity with lower interest rates, remember most home buyers are locked in at under 3%. And so that equity has been enormous. And I think you do have people who are trying to cash out maybe and buy up, trade up. That's a good reason to cash out. But it also means that some home buyers are locked into their ATM. They can't get money out because getting money out requires them to get it out at a higher interest rate. So ironically, even though there is a segment of homeowners who are flush with cash in their homes, it's too expensive to withdraw right now.
I guess that goes to this question of if the Fed starts cutting rates and we do get easier financial conditions, which we've been talking about, does that boost longer-term inflation because people start to cash out of their homes, because people then start to take out mortgages, because that sort of keeps everything in play at a time where there is this stickier underlying component you're talking about?
Exactly. We're on a hair trigger. A drop in interest rates will unleash a lot of pent-up demand. And that is the story of the housing market, not just this year, the past 10 years. So this is a story we've seen over and over and over again. As soon as there is a window, the buyers come in.
How big is the window, though? How much do rates have to go down before people get in?
Look, I think it's all about inventory. I actually don't think it's about the rate. There are enough wealthy buyers in the market. There are enough cash buyers in the market that they can actually support this housing market if there is a drop more of inventory. So it's an inventory story, not a rate story. And that's why the Fed is going to have such a challenge. If they could control it like a lever with interest rates, then this would be a foregone conclusion that we could get CPI down to a 2%. The problem is inventory is going to be resistant to even the Fed's attempts at lowering interest rates.
We're hearing a lot about housing from Washington. President Biden mentioned it in his State of the Union, talking about rebates to help people get on the property ladder. Wouldn't that exacerbate the problem to drive up demand?
Maybe. But the problem is that there's not enough affordable housing. So it's a question of whether those rebates will actually be meaningful in a market where, if you look at a lot of the inventory, it's way out of reach of where wages have been, even though wages have accelerated. So maybe at the margin, some people do benefit from a rebate, but that's not going to characterize the entire market.
Because it's the supply side, so they need to do something on the build side.
Exactly.
What can they do?
That's the problem with housing. It's all at the local level. So it's local zoning rules. It's local property taxes. It's hard to have a national housing policy. We did before the great financial recession. We don't as much now, and I think that is playing out with the affordability issues that we're seeing right now, which points back to inflation, which leads to the Fed. So housing, to me, is the watch point. It's the big boulder. It's maybe even the elephant in the room when it comes to inflation.
Let's finish on the labour market. You've got tons of data. What are you learning from wage growth for job stayers versus job changers?
So this is really interesting because if you go back with me a couple of years, we've been looking at payroll data. So about 25 million workers overall, about 10 million that we can match over a course of a year in the ADP payroll data. We've seen some interesting stuff here. Wages basically peaked in 2022, spring and summer. They moved sideways for the better part of that year. And then in 2023, they started to edge down. That's great news. But more recently, we've seen for people who've actually changed jobs during that year, a bump up. That's the first bump up since November 2022. That, to us, is an interesting watch point because it may be symptomatic of a market that's not quite as cool as we think. Depending on the jobs that are being produced, you might see some increases in wages. They may not decline in a straight line.
If you don't get a crack in the labor market and there still is this strength that you see as being likely, then do we really kill inflation? Does it all come down to the fact that we're not having real weakness and enough weakness in the labor market, and you need that in order to get inflation lower?
I think the fallacy of the narrative around inflation right now is that we are at the end of the book instead of the end of the chapter. And inflation is going to be a recurrent phenomenon in the economy because you have these two big drivers of inflation, jobs and pay, and labor shortages, which in my view will be persistent, and housing and inventory, also shortages that will be persistent. Those two big drivers keep this as like a never-ending story. Every chapter, you may get down to 2% and not stay there for very long. Let me just put a fine button on this. It's like the Fed is holding a very complicated, intricate yoga position. And They could tip over at any time, but they have to hold that position for a very long time to see inflation come down. So this is where we are right now. I thought that would resonate.
Thank you.
Nita, we've all got visions of Chairman Powell trying to do yoga this morning.
Putting his arm out here, his leg down this way.
No. Nita, thank you.
Around.
This was great. Really thoughtful stuff. Nita Richardson there of ADP. I love this quote. My view is that inflation will continue to decline to a point, and that point may be as difficult for the Fed to maintain, Lisa, as it was to reach.
Like a yoga position that's very complicated with Jay Powell potentially contorting himself. But this is true, right? Because of these issues and this concern about preventing another recession, given how damaging it can be and how hard it is to claw back, it seems like that's so in the forefront of their minds that they're willing to maybe not hold the position quite as long.
I don't know any yoga poses.
Oh,
really?
Crow pose,
That
scorpion
explains-
handstand.
What's the scorpion handstand?
That one's hard. You're doing a handstand, but your legs are still kind of bended over.
Okay.
Do you think it's more of that or the crow pose? That's pretty hard. I'd love to see Jonathan do this in the commercial break.
Crow pose. You can show me in a commercial break. Coming up next, Mira Pandit of JP Morgan, Ed Mills of Raymond James, George Ferguson of Bloomberg Intelligence, and Earl Davis of BMO. The second hour of Bloomberg Surveillance coming up next.
Let's make it clear, still we will get cuts this year. This recent talk about no landing, no cuts, we think the market is going to start pricing that out.
The likelihood of them not cutting this year is basically zero. The likelihood of them being in a hurry to cut, I think that is pretty small as well.
Do you cut in May? Do you cut in June? Do you cut in July? The timing of that rate cut, I think Fed officials are right. It doesn't really matter.
They have to feel as though the groundwork has been set for consistently lower inflation.
We're still living through this experiment yet to be played out on inflation and interest rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
CPI data 90 minutes away, live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance. Equity futures right now positive by 0.25%. It's the last read on inflation until next week's Fed meeting. And the recent data derailing, Lisa, some of the happy talk around disinflation.
Given the fact that we saw hotter than expected CPI and PPI, does this confirm this, as you've been talking about? And right now, how vulnerable is this market to really a gut check about just how quickly disinflation actually is happening and how hard the last mile really is?
Well, the market has been more vulnerable than the Federal Reserve has been. We've been repricing the Fed aggressively. The Fed has been unchanged, unmoved, hardly derailed by any of this. And they're going into their meeting next week where we get a new set of projections and hardly anyone on the street thinks they're going to change versus where we were in December.
I feel like the market is kind of like a histrionic person who just keeps, switching because there's nothing else to do and they're basically bored and their trade's going on. I mean, at a certain point, everyone's trying to figure out how to get an edge at an edgeless time where the data is messy and nobody can really predict the future. So you get these really messy moves. And right now, if you look at options trading, it looks like there could be a lot of volatility with an upside surprise.
Messy moves and then the revisions. But above the top line, what's interesting about inflation is we can actually see where they're making progress, where they're not, and how long the rest of the year it's going to be difficult. Bloomberg Intelligence, and we just heard from Neela Richardson, really looking at housing and shelter costs. Bloomberg Intelligence really looking at gasoline. This is really critically important going into peak driving seasons. And what this means for Americans, polls continue to show that Americans identify prices of goods and services as the best indicator for how the national economy is doing.
That's the CPI report, 8:30 Eastern Time. I want to turn to a single name, Southwestern pre-market, negative by a little more than 5%. A couple of headlines dropping in the last 30 minutes or so. Reevaluating all prior full year 2024 guidance, planning to cut 2024 capacity and citing one company in particular. Lisa, that company is Boeing.
I'm wondering whether Boeing's going to have to pay anyone anything. I mean, seriously, given the fact that there's a lot of lost revenues. But Southwest also talking about how otherwise first quarter bookings were actually up and they were actually increasing faster than expected. This is sort of a strange story. On one hand, you've got the disaster that's Boeing, right? And how that's going to evolve with the DOJ lawsuit and all sorts of other claims is one thing. But another thing is a lot of these airlines are still doing well, and it's a question of getting enough capacity to meet demand at a time where this economy just is not rolling over. That, to me, might be one of the most interesting angles of this sort of kitchen sink report.
Boeing down another 1%, Southwest down 5%. AMH, this is the comment from Southwest on when we get that updated 2024 outlook. We have a date. April 25th is the date. Planning to give updated guidance on April 25th.
But it feels like we have the updated guidance when it comes to the 737. Deliveries, there'll be no. That's what they're assuming right now. There's going to be no deliveries. And they continue to assume in this report no 7 aircrafts are placed into service this year based on the current certification status. So until Boeing gets its act together, this is going to be a ripple effect across the airline industry.
It's a break of 32 in a pre-market for Southwest. Broadly speaking, equity futures doing OK. Positive by 0.25% on the S&P 500. Yields a little bit lower on a 10-year. We're down about a basis point to 4.09%-ish. In the FX market, euro-dollar 109.35, basically unchanged. Coming up this hour, Mira Panda to JP Morgan ahead of a key CPI print. Ed Mills of Raymond James as the TikTok bill gathers momentum in D.C. And Earl Davis of BMO on his, quote, great buying opportunity in Treasuries. Earl Davis has been dead on in this bond market at the front end of the curve, Lisa. Looking forward to his thoughts on the longer end, on a 10-year.
Absolutely, especially because Barclays came out and talked about potentially saying, the rally's gone a little bit too far, but he has been dead on. And it's been tactical, and it's been brilliant, so can't wait.
Great start to the year for the team over at BMO. We begin with our top story this hour. The US CPI report 90 minutes away after a hotter-than-expected January print. Today's February read giving investors more clues on the Fed's soon, but not too soon, rate cut timeline. Mira Panda to JP Morgan writing this: a slowdown in the economy will likely be one back to trend rather than into recession. The Fed is likely to fulfill their projection of 75 basis points of rate cuts this year, with the first starting in June. Mira, I'm pleased to say, joined us now for more. Mira, good morning.
Good morning.
You came into this year calling it the 2024 economy, 2024. Can you explain what 2024 actually meant, the meaning behind it, and ultimately where we are now a few months later?
Sure. So 2024 is 2% real GDP growth, 0 recessions this year, given the data that we have. 2% inflation, somewhat controversial, given that people think it's a little bit sticky where it is, and just under 4% unemployment. And that's broadly where we're trending to. If you look at the data that we've gotten, Atlanta Fed GDP tracking to be just above 2%, unemployment just below 4%. Now, the key is inflation. Does that continue to progress towards 2%? And I do think, look, we have multiple inflation prints, not only CPI, but also PCE until we get to the Fed's June meeting. And I do think it's not going to be an even path, but that data will increasingly confirm that the Fed should be ready to implement modest cuts in light of a benign economic environment.
Late spring was the date coming into this year for you. Has that date shifted out or stayed the same?
It shifted out a little bit from May to June, so not a huge shift, but I think that what has been helpful is, one, the Fed speakers have been pretty consistent in the way that they've approached their timeline this year in terms of the long engagement. You know, we've committed to doing this, but we're not going to set a date yet. And now they're getting closer and closer towards let's do this in the summer, given what the data might show. And I also think the very helpful thing for the markets is that finally you've seen the Fed and the markets converge. So I do think that de-risks to some extent a lot of these jobs and CPI prints that we're getting, because there's not that much of a delta between the two.
I love this. We get people on like yourself, and they have a longer term horizon, and they start talking about how it doesn't really matter whether they cut in May or whether they cut in June. And then you have reports saying that the market's going to go haywire if we get a hotter than expected CPI print, because it's going to push out how many cuts and when they start. So which is it? I mean, how vulnerable is this market to a hotter than expected CPI print?
It's how vulnerable is the market to surprise. And again, right now with Fed expectations and market expectations fairly aligned, I think it's a lot less vulnerable, certainly than it was a few months ago, when you would see a lot more rate volatility around any time a Fed speaker got up to the podium or any piece of data that we got. I think that there's a little bit more comfort. And I also think, look at some of the Fed's projections. We'll see next week how those change. But if you look at headline core PCE, we're really not that far today relative to where they want to be at the end of the year. So isn't that a pretty good sign that they came up with these projections last December and, you know, we're kind of getting to the right place?
Well, so there's another question, too. It's not just how much is the market potentially vulnerable to a shock. It's which stocks are most vulnerable, given the fact that we've seen this huge run up in the Magnificent Seven and the momentum stocks. Do you see this fragility there, or is it elsewhere? Is it sort of a consolidation of earnings and profits in a select number of companies that will make them less vulnerable to some of the volatility that some people are expecting?
I think the macro, or the micro is very much defying the micro, because you would think, okay, if there's some vulnerability around the macro outlook in terms of the path of rates, that's going to shock stocks. But I think instead we're just seeing a broadening out in, okay, if it's still a reasonably good environment, the Mag 7 can do fine. But is everything else going to start to come along? And you're starting to see that, especially when you think about how that's underpinned by earnings. Last year, you had profit growth that was essentially in aggregate negative across everything in the S&P 500 except for the Magnificent Seven, which were up 30% plus. This year, we're expecting to see about 40% of profit growth coming from the Magnificent Seven, but about 60 from all the other stocks in the S&P 500. And each quarter, that is going to improve until we get into the end of the year, where we're actually projected to see a flip, where you're going to see more growth coming out of the rest of the index relative to the Mag 7. Now, still very impressive growth numbers, but it's hard to get too spooked by stocks when earnings have been as strong as they have.
I struggle with the logic just in terms of how GDP is set to decelerate, but earnings contribution from elsewhere will increase. Why do you think such strong US growth over the last 12 months has resulted in such narrow leadership in the equity market? How has that happened, and why is it almost like the reverse for this year, where we're going to get less US exceptionalism but better contribution for earnings from elsewhere? How does that work?
I think a big part of it is the fact that earnings were relatively poor when you think about earnings growth last year across the board. So despite the fact that the economy actually defied expectations of recession and reaccelerated, you didn't really see that as much in the profits numbers last year. I think disinflation is helping, too, as we see more margin stability. And revenues seem to be holding up pretty well in light of accelerated economic growth. So I think that the profits really actually lagged or told a different story last year than the economy did. I think this year, as we get to, again, a reasonable place with the economy, but you do see profit growth pick up from essentially flat to double digits. That is what really propels stocks this year.
You mentioned margins. Can we talk about that a little bit? What have you noticed of how they're protecting margins? Is this cost cuts? Are they laying people off? Where's that coming from?
It's a little bit of both. You do hear a fair amount of layoff announcements and people being prudent about hiring going forward. I think that in certain sectors, staples, for example, there'll be a little bit more pressured in terms of cost cuts. We haven't really seen it across the board, but I think companies are certainly willing to do what it takes to defend margins throughout the year. The question is, what will it take? Because if we do still see a reasonably healthy consumer backdrop, there may be less of that they need to do.
Given the fact that we keep talking about American exceptionalism, given the fact that we're not seeing layoffs, given the fact that we just were talking to Neil Richardson about how sticky some of this inflation is, what's the threshold for rates at which point stocks can keep gaining, at which point stocks are still a positive type of investment?
Well, we have seen that stocks have done pretty well through the 3% into the 4s, nearly kind of getting into the 5s as well. So I think that stocks overall, if the economy is reasonable, if the earnings picture is reasonable, can be quite resilient in a variety of rate environments, which we have existed in even in just the last 6 months. So again, I really do focus a little bit more here on the micro than the macro. And you're seeing that globally, too. I mean, despite the fact that we have potentially, technical recessions or near technical recessions in areas like the UK and Japan and Europe, you're seeing that not only are U.S. stocks at all-time highs, but also within Europe, Germany, France, go over to Japan. So you are seeing that disconnect there, which I think is a healthy thing because people are paying a little bit more attention to stock selection. I mean, if you look over the last 25 years, you've basically seen half of the best 50 performing stocks each and every year essentially come from international companies, internationally listed companies. So I think it does make the case for really being pretty discerning in terms of which companies you're going after, as opposed to worrying too much about the rate and inflation environment, because we've really seen the gamut over the last couple of years.
Mira, stick with us. Got a lot to get through. Mira Pandit there of JP Morgan Asset Management. If you are just joining us, inflation data, 8:30 Eastern Time, about 1 hour, 20 minutes away. The estimates look like this, month over month. 0.4% in our survey, up from 0.3 in the previous month. Core, stripping out food, stripping out energy, looking for 0.3% versus 0.4. That data hits at 8:30 Eastern Time. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. Speculation is growing. The Bank of Japan may be getting closer to raising interest rates. Sources say a final call will be made Friday. This is when wage talks between Japanese companies and unions wrap up. April remains the most popular prediction for a rate move among economists surveyed by Bloomberg. We'll see what the BOJ decides next week when it holds its policy meeting. JP Morgan CEO Jamie Dimon issuing a warning on the U.S. economy, saying recession is not off the table just yet. He told a business summit in Sydney the chance of a soft landing in the next year or two is about 35 to 40%. Diamond says economic indicators have been distorted by COVID-19, and he takes them with a grain of salt, saying the Fed should wait for more clarity before lowering interest rates. The cocoa rally is showing little signs of slowing. This as bean shipments from the Ivory Coast came in far below last year's level. New York futures rising as much as 4%, erasing losses from the previous two sessions and pointing to a tighter global market. The lower output from the smaller mid-crop harvest has added steam to the rally, which has seen the price of cocoa jump by over 60% this year. That's your Bloomberg Brief. John?
Yahara, thank you. I love this story from the Washington Post just dropped. Former President Donald Trump asking Elon Musk last summer whether the billionaire industrialist would be interested in buying Trump's Truth Social. According to two people with knowledge of the conversation.
Well, maybe that's recently why he was meeting with the former president. Everyone was talking about this was about Elon Musk getting into the campaign donations game. He said on X, Twitter, that wasn't it. Maybe it's about Truth Social.
I'm not sure how much capacity Elon's got to make another acquisition. Ramo.
I just want to know why he wants to raise the money.
True. That's the latest from the former president of the Washington Post. More on that a little bit later. Up next on the program, the TikTok bill gaining momentum in Washington.
This bill does not ban TikTok. It just bans the Chinese Communist Party from essentially owning it. I hope it gets a vote. I think that we don't need the Chinese Communist Party telling our kids what to watch online.
That conversation up next, live from New York City this morning. Good morning. Equities on the S&P 500 positive by 0.2%. Yields a little bit lower by a single basis point, 4.09%. The CPI data just around the corner. Under surveillance this morning, the TikTok bill gaining momentum in Washington.
This bill does not ban TikTok. It just bans the Chinese Communist Party from essentially owning it. I'm trying to ban TikTok. I hope it gets a vote. I think that we don't need the Chinese Communist Party telling our kids what to watch online, which is essentially what's going on here. And I just want to see TikTok survive and thrive.
Here's the latest. A bipartisan bill that would force TikTok's parent company to sell the platform or face a ban is gaining traction in Congress. Officials set to brief House members on the bill today ahead of a vote tomorrow. Ed Mills of Raymond James writes in this: while the bill has a high probability of passage out of the House, we believe the Senate may be more skeptical, given concerns about the legality of the bill, with notable pushback from TikTok users adding to bipartisan concerns about losing the younger voter crowd. Ed Mills joins us now for more. Ed, we've been talking about this for the best part of 4 years and nothing happened. Is that about to change?
Maybe. I think that this bill is absolutely going to have a massive vote tomorrow out of the House of Representatives. But after that, it slows down. The Senate has a different approach. The Senate Commerce Committee chair has said that she would prefer to have larger authority to take a look at different apps controlled by countries of concern and potentially regulate that here in the United States. So Joe Biden has said that he would sign this if it comes to his desk, but he knows that there's the ability to change this in the Senate, deal with some of those legal and political issues. And to me, the real question before it passes is how long does it take between the Senate and the House to work out those differences before it even could get to Joe Biden's desk?
Or potentially someone just buys it in the medium term as they go along on this very long process. Yesterday, we got the annual report on global threats. And here's what it had to say. China is demonstrating a higher degree of sophistication in its influence activity. It goes on to say TikTok accounts run by a PRC propaganda arm reportedly targeted candidates from both political parties during the U.S. midterm election cycle in 2022. If they know this, and you also had Christopher Wray on the Hill yesterday talking about the national security concerns, how can any politician vote against this?
Well, that's what I've always said, that in politics, when you're explaining you're losing, the vote last week in the Energy and Commerce Committee in the House was 50-0. So no one wants to vote against it. But as soon as that bill passed, the top Democrat on that committee, he's in the minority, came out and outlined a number of those concerns. It is bonkers to think that you would have a foreign government that is not an ally controlling what people are seeing here in the United States. When I talked to national security officials after the October 7th terrorist attacks in Israel, there was a lot of concern of how quickly, especially among the youth, there were sentiment shifts that were not expected. As we go into the election, there's going to be even greater concern about those influences on voting. So ultimately, something has to change here. It's just a question of that process in the timing at this point, in my mind.
Former President Donald Trump has thrown some cold water on this bill. Does that change the minds of some Republicans?
In a little bit, yes, but that's why the FBI director, the Office of the National Director of Intelligence is going to be up on the Hill today to discuss with the members of the House why they think this is a national security imperative. I do think it is part of the reason why you saw some members of the Senate come out and say, we are not willing to just adopt the House version. First and foremost, the Senate almost never takes what the House does and just signs it into law. But what you need to do in the Senate, if you were to take the House bill, is unanimous consent. So it denies the ability of unanimous consent. And it's actually a gift to Democrats who want to make some of these changes that Republicans are not going to be able to blame them. There'll be at least one or two Republican senators who is blocking this bill, giving the opportunity for the Senate to do their work. And the question is, can what the Senate produce and what the House produce get reconciled and make it to Joe Biden's desk? Will we see an actual impact on TikTok before the election? I'm pretty skeptical.
Ed, forgive me, I'm going to do something dangerous. I'm going to ask you to read the Trump tea leaves, if we can. What do you think his position on this signals more broadly about how he might govern regarding China?
It's a good question, John. I think that all of the conversations we've had at Raymond James about Trump's potential re-election in China, first and foremost, a less predictable relationship. Number two, seems to be very focused on tariffs. And number three, somewhat transactional. There is going to be a question of his business interests in Truth Social, any of the campaign contributions he's had in his position on TikTok. What does his ownership of Truth Social do as it relates to the potential benefit for other social media companies? He highlighted Facebook and Meta yesterday. A lot more questions of what is driving those decision makings, and that unpredictability and the volatility that comes with that from the market is where a lot of our conversations have been with the clients of Raymond James here.
And to put a bow on it, though, just quickly, less predictable and more volatility does not necessarily mean worse than what we currently have, right?
Well, we have viewed the current administration as picking up everything that Trump did on China and bringing it to the next level, but has done it in a more process-driven basis that is going to be easier to uphold on legal challenges. So neither is, kind of good for China. It's just the question of how bombastic that relationship would be, John.
A very different approach. I'd appreciate the clarity. Ed Mills there of Raymond James. Still with us for a final thought. Mira Pandic at JP Morgan Asset Management. Mira, go-to question for us around the table over the last few weeks. How tough is this going to be for multinationals to navigate? Is that really what I want exposure to? A very unpredictable, volatile relationship between the United States and China?
It will continue to be a challenge, and that's almost regardless of the political situation that we're undergoing, because this has been a long-standing issue for 6 to 8 years now. So it is something I think that they are more accustomed to dealing with, and especially after the pandemic with some of the non-politically related challenges with supply chain. I think companies have readjusted some of their global strategies in terms of how they will operate, but certainly it's an additional headwind. So I think it will be a challenge, undoubtedly, but not necessarily a new one that companies are going to have to deal with. You write in your note, it's not always policy and politics. It's also about what's going on in the time. You talk about the energy sector. It's actually shocking how clean energy did well under Trump, and actually fossil fuels is doing well under Biden. How do you prepare for potentially Trump 2.0 when you look at historically something like that? I think you have to remember that because sector implications don't play out how you think they will. We have this idea these sectors will do well under a Republican, these sectors will do well under, a Democrat. And what you point out is essentially that during the Trump administration, you saw essentially clean energy up almost 3x, whereas you saw traditional energy down by about 40%. Within the Biden administration, you saw clean energy halve, whereas you saw traditional energy double. And that had to do with, under Trump, low oil costs because of the pandemic, low interest rates helping some of that clean energy financing. Under Biden, it had to do with the war between Russia and Ukraine, recovery of oil prices, also some of that uncertainty around policy itself. So sometimes policy can actually have the equal and opposite reaction, bringing us back to physics class in terms of how you think things will play out in the markets. So really important not to try to play politics with your portfolio because it rarely works the way you think it will.
Mira Pandit of JP Morgan. Mira, appreciate it. Donald Trump, I do wonder, too early to draw conclusions, but Lisa, you do wonder what his approach on TikTok means for his broader approach to China in the years to come if he gets back in the White House.
I thought Ed put it really well. It shows how complicated and transactional it's going to be. If it affects, Truth Social, does it change the scenario and raise a question about what national security means?
Not just Truth Social, but does it affect his ability to bring in top dollar donors? Jeff Yass, he recently called, quote, fantastic, an individual he's trying to bring in.
Yeah, campaigning versus governing are two different things, I guess.
Are they?
Coming up on this programme, shares of Southwest falling after the airline announced plans to reduce its capacity in 2024. Not going there at all. That was almost a hot mic. Almost. Equities right now on the S&P positive by 0.2%, on the Nasdaq positive by 0.4%. 2 days of losses on the S&P 500. Last week, a very rare week of losses. We've only had 3 of them since the end of October. Just a stellar run in this equity market. In the bond market, 2-year, 10-year, 30-year looks like this. Citi are calling it inflation week, and it is. Starts with CPI data a little bit later this morning. 2-year, 453.80. Yields a touch higher there. No drama. Little bit lower on a 10-year. Basically unchanged. 4.09%. A real flavour, a picture of inflation in America, Lisa, this week, going into the Federal Reserve decision in about a week's time.
Yeah, it comes at a time where we've already had this incredible rally and people basically are saying all those zero-cut call people, hey, I'm looking at you, Torsten Slok. They've come on this show and said, I don't think so. It's not going to happen. This is kind of the gut check, right? And I keep going back to what Neil Richardson was saying. The housing market's still strong and it's a supply side issue. Labor market might be stronger than it seems when you look under the hood. How does that come to the final mile that everyone's already baking in?
Steve Risciuto, Mizuho, another no rate cut call for 2024 is coming up a little bit later, about 60 minutes from now. Want to turn to foreign exchange. Let's pick out a currency pair together. Let's take dollar yen. Japanese yen right now, a little weaker after several days of strength, 147.37 on dollar yen. Another report, this time again, here from the team at Bloomberg, suggesting they're very close, considering to hike in interest rates next week, Bramo, if, and it's an if, and it's dependent on what happens on Friday with those wage negotiations.
It also depends on what happens today with CPI in the U.S. I mean, just to think about how they're trying to calibrate this perfectly to do it with the least disruption possible. To me, the fact that you get a little bit of a weaker yen highlights that any uncertainty about a rate hike next week. That's right, rate hike. We're talking about rate cuts everywhere else. It's hard to get your mind around right now, given the fact that it's just
haven't done it for 27 years.
It's also not what anyone else is
17.
Doing. Yeah, I mean, it's basically this is where people's minds are at right now.
147.36 on dollar yen right now. I'm with you. Every time I say it, I'm like, yes, rate hikes,
right?
Not rate cuts.
I mean, how many times have you messed that up with the Fed? I've done that.
What, calling rate cuts rate hikes?
Yeah.
All the time. Guests do that too.
Oh, I know.
It's just dependent on what you're used to. Right, it's not a big deal. It's okay, Lisa. It's all right. 147.36 on dollar yen. Under surveillance this morning, a little under an hour away from US CPI. After a hotter than expected January print, our survey expecting a slight uptick in headline inflation, with core continuing its trend lower. Bloomberg Economics expecting increased gasoline prices to push up the headline figure, writing, quote, we don't expect the February report to provide clear enough evidence of disinflation to boost the Fed's confidence to cut interest rates. I think most people are on that page. Regardless of what this says today, Lisa, it's too soon. If they want a little bit more evidence, I don't think that's one CPI print. I don't think many others believe it is either.
And a lot of people are looking to June, right? Which is the reason why that's the consensus rather than this month. Gas prices, nobody really cares because it's going to be a seasonal thing. That's what people are saying. However, we did see inflation expectations creep up just a little bit in the New York Fed Consumer Survey yesterday. it's not going to be conclusive. I think that's what we've heard from guest after guest. So why would they make a move or really change their expectations?
It's not going to be conclusive, which is why Mohamed Al-Larian says the Fed has become not even data dependent, data obsessed. I was looking at the Misery 2 index. Why this is interesting is because this has more cumulative inflation rates baked in. And what it shows is that voters in 7 swing states actually say inflation is worse than voters overall in states that normally vote deep red or deep blue. That spells for me a massive problem for this White House. And that's why CPI prints like today are really important.
Just to spell out the estimates for you, we're looking for 0.4% headline month over month, up from 0.3. Core, stripping out food and energy, 0.3 versus 0.4 in the previous month. Elsewhere, tensions rising between President Biden and Israeli Prime Minister Benjamin Netanyahu as the death toll rises and ceasefire talks stall in Gaza. Biden calling an assault on the city of Rafah a, quote, red line. Netanyahu not backing down.
The gas. I'm telling you that we have to take care of Israel's security and our future, and that requires eliminating the terrorist army. That's a prerequisite for victory.
A prerequisite for victory. What happens if he crosses that red line? Do we know?
We don't know yet, but we do know, and Politico was reporting that potentially Biden would put strings attached to weapons. One thing I thought was interesting in that interview Netanyahu gave to Fox, he said we have agreements on the basic goals. We have disagreements on how to achieve them. That seems to be where the gap is. And yesterday when we heard from the White House, Deputy Press Secretary gaggling with reporters, said that they have no such plan yet about how Israelis plan to go into Rafah, but make sure that Palestinians are not in harm's way.
We asked a few times yesterday, is this a fundamental division, a big separation between two leaders, President Biden and the leader of Israel, or a convenient media narrative for the President of the United States, given his political challenges at home? We had mixed answers to that. But I think based on the Politico story a little bit earlier on this morning, suggesting that maybe they bring in some conditionality to the military aid that's offered to Israel if that red line is crossed. And I think that's the real test of that question. What is the policy going to look like if they cross that red line? Is this really a big shift, a division between two leaders, or typically, as we might be in a cynical way, expect this just to be a convenient media narrative for the president? We'll find out based on the policy, not the words in the months to come.
That's true, but I tend to read the tea leaves the way Aaron David Miller does, which is that there is a shift, and most notably because I can't remember the last time Benjamin Netanyahu and Biden spoke. And for me, it's not just did they speak recently, it's how much they've been speaking. Remember, after October 7th, they were speaking regularly. When was the last time we saw them speak in that sort of level of regularity? I have not seen that. That's
the latest on the Middle East. Let's turn to shares of Southwest falling after the company announced its plans to reduce its capacity this year, citing Boeing's ongoing challenges. This after Boeing suffered its biggest single-day drop in over a month after the DOJ opened a criminal investigation into the mid-air blowout of a fuselage panel back in January. George Ferguson, senior aerospace and airline analyst at Bloomberg Intelligence, joins us now for more. George, can you tell us just how seriously we should be taking this criminal investigation?
So I think, any criminal investigation has to be taken very seriously. Boeing obviously has its reputation on the line here. It's definitely been muddied, its reputation. So it would like the criminal investigation to come out well for it. My understanding is that criminal investigations are typical in this kind of event where you had that blowout of the plug. And it doesn't necessarily indicate that they have evidence that there's criminality here, but they want to make sure there's been no criminal act that would have created that problem. But I'm not an attorney, typically an analyst by day, so that's my understanding of the criminal side of this.
George, I'm struck by the fact that the news gets worse and worse for Boeing every single day. I mean, honestly, we heard this report that basically safety regulators went in there and found huge gaping errors in just how they have their protocols laid out and the confusion around them. Where's the floor here? Shares are dropping, but there's also a complete lack of any kind of sense of whether we've gotten to the bottom of this.
Yeah, so I agree. I mean, it seems like the bad news just keeps coming here. I do think that, the reports I've seen indicate to me that part of the fix has to be this buy of Spirit Aerosystems. And so this may well start to be a floor as Boeing explores how to take apart Spirit Aerosystems. Inside Spirit, there's some Airbus business, but there's a lot of Boeing business. And I think they can't afford to have any muddied lines between what Boeing wants to do on quality and production, and a Spirit management. And so I do think I think it's something they never wanted to do. They spun Spirit out because it was a lower margin business. They didn't want to be involved in it. I think they've ran it this far trying to keep Spirit outside, but I think they've just looked down there and said it's too integral to the build of the 737 and the 787. They're two most important airliners, and they can't control what's going on down there. They can't stabilize what's going on down there, and they've got to get in there and fix it from the very beginning all the way up into Boeing and Renton, Washington.
George, do you think we could see any more shifts in the C-suite?
Look, C-suite's job is to build airplanes correctly the first time, all the time, make sure, all of the processes that are in place are followed, and it's not being done right now. And so I think that absolutely puts the C-suite at risk.
Well, I say this because the U.S. crash investigators are accusing Boeing of not even being able to cooperate in the probe. Doesn't that spell a massive error at this moment when they should be trying to cooperate?
I would think they would want to be cooperating here as well. But I also think that there are probably situations in this investigation where you might have differing opinions on how things should be. But it's a really, really tough spot to be in right now. And I think Boeing probably needs to be a lot more receptive to some of this feedback than trying to manage it.
What I find interesting, George, is that the Boeing debacle seems to be masking a lot of actually good news under the hood. We're seeing a lot of bookings that are coming in stronger than expected. People are still traveling a lot more than many of these airlines expected with Southwest. That was sort of the silver lining, that they actually had greater numbers of bookings than they had expected. How much has this sort of muddied or blocked out the sun that has really been cast over the rest of, frankly, the travel industry?
Yeah, I think an interesting thing will be, right, is that if you're a Boeing flyer, an airline flying Boeing, you may not have enough capacity to take advantage of that. And so I think it has been, a bit of a silver lining. We continue to see fares sort of ebbing down, so we don't see, profitability doesn't look like it's going to be, it was last decade for the airlines in the next year or so. I think the consumers held up okay. Again, we're seeing it start to slide, but one of the silver linings could actually be that there's not enough airplanes in the market, and if you're not a Boeing flyer, you're an Airbus flyer, you're going to be there to take those rewards. So it's maybe glass half full, glass half empty for those that are Boeing flyers.
Take those rewards for the airplane companies, the airline companies, not necessarily for the consumer. Does this mean that prices probably are going to go up if capacity is constrained?
Typically when capacity is constrained, prices absolutely do go up. And if you look at profitability at U.S. Airlines, like I said, it's not last decade profitability. The pilots got big pay increases. That's really impacted it. Fares actually do need to come up for these airlines to earn an appropriate return on capital. So I think they're too low right now.
George Ferguson of Bloomberg Intelligence. George, thank you. We heard that same warning from Ryanair, and that was almost like the trial balloon to higher fares through the summer, wasn't it?
That's exactly what I am hearing. Capacity is constrained, so guess what? Prices are going up ahead of the CPI print. Sort of interesting.
You know what's happening next, later this summer. Capacity's down. It's Boeing's fault. We've got to put up
100%
fares.
I'm just expecting it. Basically, I want to go
know.
book all my flights as soon as I'm done with this call.
Get it done.
Equity
Seriously. Futures right now on the S&P, just about positive. That data coming up a little bit later. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Bank of America disclosed pay raises of more than 10% for two of its highest-ranking executives, even as its CEO, Brian Moynihan's compensation was cut for 2023. CFO Alastair Borthwick's total pay climbed 14% to $12 million last year, while Jim DeMare, head of the bank's global markets division, saw a rise of 11% to $21 million. Meanwhile, Moynihan saw his pay cut 3% to $29 million in 2023. U.S. small business optimism hit a 9-month low in February, according to the National Federation of Independent Business. The report citing high prices and borrowing costs taking a toll on expansion plans. Just 5% of respondents in their survey indicated now is a good time to expand their business, while a net 39% see business conditions getting worse. Rupert Murdoch's News Corp is reportedly in talks for a takeover of the UK's Telegraph. News Corp is said to be working with the owner of the Daily Mail and UAE-backed investment fund Redbird IMI on a potential deal. A joint bid by the three would result in a smaller stake for Redbird IMI, which would reportedly ease concerns by British politicians over foreign state control of a legacy media outlet. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, market signal. The coast is clear.
Then we continue to have stronger U.S. growth. And this U.S. exceptionalism story keeps coming back. You have pockets of weakness and pockets of concern. Markets are concerned about private credit. Markets are concerned about the regional banks. None of these are systemic issues at this point.
That conversation up next. Update on stocks right now, positive, just about by 0.25% on the S&P 500. In the bond market, lower on yields by a single basis point, 4.08%. The euro a touch stronger, 109.34 against the dollar. Under surveillance this morning, market signal, the coast is clear.
We continue to have stronger U.S. growth, and this U.S. exceptionalism story keeps coming back. Economists and policymakers are all having trouble contextualizing why is the U.S. economy so strong. So I think that it comes back to that. We don't have a broad recession. It's hard to see signs of that. You have pockets of weakness and pockets of concern. Markets are concerned about private credit. Markets are concerned about the regional banks. None of these are systemic issues at this point.
And markets are not concerned about additional supply. Bond yields slightly lower ahead of a busy week of auctions with a combined $61 billion in 10 and 30-year debt to be sold over the next 2 days. Earl Davis of BMO saying this: we believe that there will be continued upward pressure with incoming 10 and 30-year bond supply. This will be a great buying opportunity. Credit markets have continued to rally with a solid bid to risk assets. Markets are now discounting an extremely low probability of recession. Earl Davis, I'm pleased to say, is with us right now. Earl, let's get into it. I gave you the victory lap last time around, so I've got to stop complimenting you. You absolutely nailed the front end of the yield curve on a 2-year. Back to where at the tippy top, 470, I believe, a couple of weeks ago. Further out along the curve, you were still looking for yields to climb, maybe to 450, perhaps out to 470. What's been happening on that side of things?
Yeah, we've actually had a good, I'd say, underlying rally in yield since we last spoke. You know, we're tactically short. We'll cover today and go very small long. But that bid into supply, both on duration and credit, we've seen record credit and, you know, spreads keep tightening, tells us there's some significant underlying demand. So we're just going to be slightly overweight. And the reason why we're not going to end up more overweight is because we're bang in the middle of our range for 10-year bonds that we saw for 2024. The range that we anticipated is the range of 2023, so 3.25 to 5%, right in the middle. But that demand, we're respectful of the demand, so we're just going to be slightly overweight coming out of supply this week.
Earl, I want to just talk a little bit more about how you do think that just the incredible demand has sort of shifted your opinions. Where has the demand come from? Why has it been so much stronger than you previously expected?
That's a great question. Well, the demand to start the year was coming from retail, and I think we were all speaking about that. And the reason why that was coming from retail is we had a strong fourth quarter. Retail likes calm markets and markets where they're rallying, so they bought, reduced the volatility in the bonds, and they continued buying. Where the balance of the demand is coming from is a little bit of a question mark at this point in time, and we're doing some research into it. So, because to tell you the truth, I'm not quite sure. But given our view that, you know, we're coming towards the end of the business cycle, it's a mature business cycle, we think we prefer to err on being slightly overweight than underweight at these levels.
It's an interesting moment to do this because we do have, of course, CPI coming out in about 45 minutes time. The expectation is the economy is stronger than a lot of people have been expecting. And then we get that supply, $39 billion of 10-year notes later at 1 p.m. Eastern. Barclays strategist actually turning short on longer-term treasuries, saying incoming data suggests that the U.S. economy remains resilient with the labor market generating solid real income growth. The rally over the last few weeks seems excessive, and we recommend shorting 10-year U.S. treasuries. Why don't you agree with that, Earl, given the fact that you probably agree with the assessment of the economy, but you are seeing something in the market that just doesn't cohere with that?
Yeah, it's very interesting. You are getting tremors, before you get the earthquake. I'm not saying it's an earthquake, but you're seeing it in the employment number. You're seeing it in some other numbers where, the totality of the number, once you dig inside, is not as strong as the headline. Having said that, we do think we remain resilient for at least the first half of the year. That's why we're not going significantly overweight. But to our point, if we do get a strong CPI number today and we do get a sell-off in bonds, we will be a buyer.
What will you be buying with? Is it going to be moving out the short end into the long end? I mean, this has been something else. What was it, T-bills and chill that we heard yesterday, that some people are saying there's no rush because rates are going to be staying here for quite a while. Do you kind of adhere to that? Or are you saying, actually, this is a good time to lock it in on the long end?
It's a good question. For 2-year bonds, for example, we're not a buyer here. If we get above 475, we're definitely a buyer. So if we get weakness, go towards 475, we'll be a buyer. We still think, the possibility ease is going to be pushed out. It's possibly a Q3, maybe even Q4 story, not a June or July. So that's why we don't like owning 2-year bonds here. 10-year bonds, we don't mind dipping our toes here. As we said, we'll be slightly overweight. If we test the recent highs at 430 to 450 level again, which is a very real possibility, we'll buy some more. And then we'll save our last sort of dry powder for above 450 in case we get there. I'm going to say one thing. Our highest conviction view this year was volatility. That's why at this level, right in between, we don't believe we stay here. And the reason why we expect volatility, there's a lot of credible views out there, us thinking rates go lower, the Barclays and others thinks it goes higher. We will see both sides of that, but we like it from a structural position to be playing this from the long side, given geopolitical risks, given where we are in the business cycle.
If there is more volatility, are some of the riskier credit spots really pricing that in or allowing that to be the case with likelihood of retaining their value?
That's a really, really good question. We actually reduced our credit on Friday, given the new lows we saw in risk assets. We did that through CDX, so we bought protection. And to your point, we still think the economy is going to be resilient and credit will be good, but we want to move up the capital structure to safer credits, and so into IGs. We still have a little bit of high yield, but no triple Cs. We're moving up the capital structure there, just because we think that volatility will impact markets. And, that refinancing walls here, we've had record corporate issuance, but, very good buying to counter that. We have what we call valuation discipline. So we don't like being overweight credit at these levels, although we don't see anything immediate that will sell off credit.
So which one is it? I'm just trying to work it out. There was the price of the story in triple C's just getting too rich.
Exactly. Yeah, you're not getting rewarded enough. I think I said this last time. We're in it for the meat, not for the fat. Where the spreads on triple C's are right now, that's all fat. That's all fat. So we're going to move to areas where there's more meat on the bone and where we have protection, given how mature this business cycle is.
Lisa mentioned earlier, she asked you, where's the demand coming from? And I would ask a similar question with regards to supply. We've had tons of it, Treasury and also in credit as well. Just within credit, where's that demand coming from?
I think it's twofold. I think what you're seeing is some real money players, your pension plans, your insurance, de-risking. So moving from higher risk assets, your high yield or lower rated IGs into higher rated credit or duration. It makes a lot of sense if you're a pension plan, given the risk rally that we've had. You're probably fully funded at these levels. So we believe that's adding to the retail buying and interest in both duration and credit. It's basically immunization strategy.
I have to ask this, Earl. When are we going to start caring about the Treasury auctions more? I mean, I always care about them and their $39 billion of 10-year notes coming later today. They've all been pretty calm. No one cares again. When do we start to care again and talk about the deficit and say, OK, supply is going to matter again for the Treasury market?
Yeah, I think, that's not about, I think people will buy treasuries as long as the economy is resilient. I think inflation comes back on the radar the second half of the year. A lot of things you were talking about prior to my segment, Israel, that's inflationary if that war becomes a hot war or what happens there. Boeing and the salaries of the pilots coming through back in airplane tickets. We spoke about B of A and those wages of executives. So, those are still out there. We're not talking about it now because the market will only focus on one thing at a time. But we definitely think inflation's the second half of this year's story. And when that happens, then you see less people being willing to buy bonds and the supply come back into the picture as well.
Interesting. Oh, great to catch up with you, sir. And I'll do it again, why not? Great start to the year. Earl Davis there at BMO, just nailing that call at the front end of the yield curve. Longer end, it's been a surprise that yields have come back in the way they have done over the last couple of weeks, but I guess encouraged by the economic data, just not surprising to the upside in quite the same fashion. Lisa mentioned the supply. I've never seen someone hope for a story so much. Hope to make this relevant sometime soon.
100%.
10-year notes, $39 billion worth today, and then I believe tomorrow we get $22 billion of 30-year bonds.
Well, I don't want to make this a story. Let's be honest. I'm not looking to manufacture news. What I'm trying to do here is no, that's not my business, I guess. But my issue here is that people talk about the deficit. They talk about how supply is increasing, and it hasn't been an issue. And at what point does that become a story unto itself? It's not an issue. Or is this basically just people doing Operation Ostrich on a smaller scale, where basically they're not paying attention until they have to? I don't know the answer to this, which is the reason why I'm asking other people.
Matters. The backdrop matters, and that's the end of the story, basically. And that's what Earl Davis was saying. If you start to see these numbers continue through the year, base case they will, and it's happening as inflation starts to reaccelerate, then supply starts to matter. If it's happened with disinflationary trends that are super durable, then this market can take it.
This is the reason why I'm interested in the tariffs. Because to me, if you start to really get tariff talk at the same time as supply is coming in...
Just say it. You know what you want to say. Liz, Truss.
I'm not going to say it. No, I've moved on. I've moved on. You can get a head of lettuce and just sit here instead of me.
It's the story that you're not wishing for it, no? Okay.
There's going to be like an AI form of lettuce instead of my head speaking.
CPI up next.
For the Fed here, I do think that they're seeing enough in those inflation readings that will get them to a cut in June.
There's a reasonable risk that they don't cut this year. If you get more of these inflation numbers similar to January, then I think those risks increase.
The start of cuts is not about easing, it's about normalizing, and inflation is what's key.
If you boil things down, the U.S. economy continues to do really well. Inflation is slowing down.
The data needs to confirm we get to 2% or lower before we can cut rates. You need to get ahead of disinflation, leave everything on the table.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
OK, this is it. The third hour of Bloomberg Surveillance begins right now, and the big data point is 30 minutes away. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance. Inflation data just around the corner. Headline, month over month. This is the guess, the median estimate in our survey. Not to offend the economists on Wall Street, I know how much work goes into this. 0.4% is the estimate against a previous number of 0.3. Strip out food and energy, Bramo. We're looking for 0.3%. month over month.
Which is down from 0.4% the prior month. And that really is what everyone's going to be looking at, because there is this gasoline impulse that will prop up some of the all-in CPI. But when you strip it out, that's what the Fed's going to be focused on.
Where does this leave the Federal Reserve, Annmarie, a week away tomorrow?
Yep, where it leaves the Federal Reserve, they're going to be focused on this. But, Jonathan, as we've been hearing from everyone, this isn't going to be enough. They're going to want another data print. What strikes me is the year-over-year CPI that we're expecting 3.1%. is not too far with the Biden administration's budget put out for their yearly projections. I know I say that this budget is just political.
Sure.
It doesn't matter. But the projections are interesting because what the administration is seeing is 2.9% inflation. That is not going to help them or the Fed when they're talking about a 2% target.
We know what the Fed is looking for. 2024, real GDP. I've got the estimates in front of me, 1.4%. Core PCE, 2.4% this year, 2.2% the year after. 2% is there a few years out.
Yeah, I don't think they're going to change it. They're probably going to keep it there. My thing is that everyone we've talked to today says that the disinflation we've seen so far is kind of going to stop. It's kind of going to stall out. We heard that from Neil Richardson with respect to housing. We heard that with respect to airplane tickets. They're going to go up because of capacity issues, but the demand is still there. You know, these are the things that are going to factor in and that have to be weighing on the Fed, even if you get a bang-in-line print that we get today.
What is in line? Can I just raise that question briefly? Is in line a beat for this market, and by beat, a downside surprise? Is in line sufficient to keep the door open to an equity market rally? Because there is a difference between what the market is looking for and what economists are looking for.
I would argue that, yes, in line would be a beat, because right now people are looking for tail risks. They're looking for this idea that maybe they're missing the inflation risk and they've priced it out too significantly. That is the biggest cloud hanging over the market right now, because everybody's priced in and prepared for disinflation, even weakness. but not a reacceleration of inflation.
Inflation data 27 minutes away. The stage is set like this. These are the scores. Equity futures on the S&P 500 positive by 0.2%. Looking across the Treasury curve right now, yields a little bit higher at the front end by a single basis point, 4.55 on a 10-year, down a basis point to about 4.09. That's the story in the bond market. In foreign exchange, the euro just a touch stronger against the weaker dollar, 109.35 on the euro against the dollar. Coming up this hour, fantastic lineup. Citi's Stuart Kaiser on why today's CPI report is the biggest risk event this month. Mizuho's Steve Risciuto weighing in on inflation data. He is not looking for cuts in 2024. And we'll catch up with David Kelly on what he calls the Fed's slow dance downward in rates. We begin with our top story. All eyes on February CPI, just under 30 minutes away. Citi's Stuart Kaiser saying this: CPI is now priced as the largest risk event in March. That is a change from the recent pattern, but we agree with it, as the FOMC is at least partially contingent on today's data. A hot report could shift FOMC dots to less than 3 cuts this year, while an easing in month-over-month core inflation would support the seasonality argument surrounding last month's data. Stuart, I'm pleased to say, is with us around the table. Stu, let's get into this. You wrote about this, which is why I've asked the question. The difference between what the market is looking for and what economists are projecting.
Yeah, I mean, I think it's actually similar to what happened on Friday with the labor market report, where I think economists considered that a miss. And from a market's perspective, we're like, hey, this looks like pretty good data. Equity markets are probably going to go higher. So, I do think from an equity perspective, Lisa's completely right. It's a tail risk story. Our view is if you print anything that rounds to 0.3 or below, it's going to be positive for U.S. equity markets on core inflation. I think if it rounds to 0.4, you start to have some issues, and that's going to really put that March FOMC as a key day.
0.3, who does it help? The whole index, part of the index, the big players, the Mag 4, not the Mag 7 anymore. Which part of the equity market is going to do well off the back of that kind of number?
Yeah, I think it helps the market at large, but I think what you'll probably see is things like small cap and some of these things that were traded as rates proxies early in the year kind of start to find their footing again and move higher. It has been a broadening out in the markets for the year in general, though, so I think it's generally a positive print, but it probably helps some of those rate proxies in particular.
I've been citing your research all week because I found it really interesting. And in the sort of guts of it, you were talking about how volatility has been picking up, the same thing that Earl Davis has been talking about just a moment ago. How much does that affect your call for the remainder of the year, whether it's good or bad, in terms of how you price risk at a time where people are expecting more volatility?
Yeah, and thanks, Lisa. We appreciate the support, of course.
Anytime.
You and my mom are OO2 readers, so it's very good.
Your mom reads it? Carry on.
Yeah, look, it matters. We've been through a period really over the last 12 to 15 months of an enormous compression in cross-asset volatility on a global basis. So to see it kind of tactically picking up, I think what that tells you is kind of the risk driver of the market has changed a bit, right? As you mentioned earlier in the year, this is all about lower yields, and does that come from a recession or from insurance cuts? The last month, it's been, wait a second, inflation might still be here. Kind of reintroducing that third risk back means people have to readjust portfolios, and you start to see volatility rise a little bit. So I think it is important because it's indicative of sort of a shifting underlying stance among portfolio managers.
How offsides would this market be to that tail risk coming to the fore of a potential reacceleration in inflation?
Quite offsides, I think. I mean, obviously, we've had a month to digest it, which helps. After the average hourly earnings, PPI and CPI last month, I think people started to do a little bit of work there, readjusting how they're thinking about things. But it would be a significant risk. I think, the most common, call it market hedges we've seen this year have really revolved around lower equities and lower yields. What you're describing would be potentially lower equities and higher yields, right? And I don't think a lot of portfolios are set up for that. So I do think it would be a meaningful change. Our view, though, is growth data can get you that big pullback, down 10%. We think if you're going down 10% in U.S. equities, it's probably because you're printing negative payrolls. Inflation, to me, is much more of that 3 to 5% type risk. And the reason for that is you have really strong underlying growth and you have very strong EPS growth. So I think that kind of sets a pretty high floor for equity markets. So I think it would be disruptive, particularly internal to the markets. But the degree of sell-off you can get, I think, is a little bit limited by the really strong growth data.
There's an implication here that's actually pretty deep, and that actually we were hearing earlier as well, which from Mira Pandit, that basically this stock market has shown incredible resilience to any kind of yield move, and that it can handle any kind of yield regime as long as it comes with growth. Are you basically saying that unless it's a really dramatic move, it is immune to potential rate shocks? So you could see a real rate shock in the bond market that doesn't play out when it comes to the stock market?
Immune's a strong word, but I mean, I think this is all, again, it's a discussion about tails. I think the equity market's view on inflation is that deep inflation tail risk has kind of been cut off. And if that's the case, I sort of put that to the side and I start talking about margins and earnings and GDP growth. So if you were to get inflation to a level where we have to kind of respect that tail again, then yeah, that becomes a real risk for the markets. I think we're a little ways away from that. You mentioned Treasury auctions. It was funny, 3 or 4 months ago, that was the big focus. You know, how bad is this? How bad is this Treasury auction going to be? That's also gotten pushed to the background. Today will be interesting, honestly. If you got a high inflation print and then you had to auction 10-year bonds, it would actually be a very interesting sort of combination of data to keep an eye on today. Obviously not the base case, but we'll see how that plays out.
You make it really simple. You keep buying until the labour market breaks. Yeah. Is it that simple, that straightforward?
I mean, for us it is at this point. I mean, look, it's obviously there's moving parts and the market's always looking at a distribution of risks and all that and all of those things. But from our perspective, if you keep printing 150 or 200K jobs in the U.S., it's really hard to not like owning equities in that environment unless you got just a really, really, large ramp higher on the inflation side of things.
Is that by the S&P 500 or the equal weight S&P 500? Where's the bias for you now? What's the split?
We still like S&P equal weight. It's made a little bit of a comeback the last couple of weeks. To be fair, it hasn't done great on a year-to-date basis. But you are seeing broadening out, right? That Mag 7 was, call it, 2/3 of S&P market cap gains in 2023. That number's below 50% now. So you are seeing broader participation. We haven't seen it get kind of all the way down to that S&P equal weight. And the reason for that is cap weight versus equal weight in the S&P is basically long tech versus industrials. And so we kind of need industrials and healthcare to really kind of move for that to start to work better.
What for you is the labor market breaking? Because we've seen a number of revisions, but the unemployment rate's still under 4%. Where does it need to go?
Yeah, I think if you print sub 100K, the market's going to pay attention. If you print negative payrolls, it's a real issue. We've sort of looked at it as a soft landing would be payrolls between 0 and 100K, unemployment rate stays below 4.5. Hard landing would be you're printing negative payrolls and you get that unemployment rate up above 4.5. But look, if we print 50K, the market is going to really pay attention to it. It's actually unfortunate because last June on a revised basis, we printed 105. It would have been really fascinating if we had printed that live, just to kind of, so we had a better idea of what the reaction function is. I mean, it's easy to say now. Back then, I probably would have cried.
Well, kind of like January.
Yes.
350, not 350.
Exactly.
So what potentially could shake your view in terms of this idea that the equity market's going to keep on rallying and that it's going to keep on broadening out, even with an economy that is supposed to be decelerating enough to keep inflation under control? Where is the tipping point, the sort of, awkward yoga pose that becomes problematic?
It's a great question. I think if you're looking at risks here, labor market's a key risk. Fundamentally speaking, I think margins is what people are really focused on if you're looking 1 or 2 quarters out. And I think the logic there is you had this very high nominal growth the last year and a half, and companies were able to defend margins in there. And I think that might have even surprised some corporates that they were able to push on price the way they were. The question this year is if you're only growing 5% nominal with all the wage inflation in the background, are you able to defend that margin? So if we started to see, that kind of margin turning over, that would kind of be your, let's call that medium-termish, kind of risk. And then obviously you have an, election and stuff on the front burner. But for me, it's payrolls and it's margins would be the two if I just had to summarize it.
We've got to unpack that, how the two are related to each other. When you said defend margins, you talked about pushing on prices, not on reducing labour and cutting costs. Is that the next step? Is that the focus for you?
Yeah, I mean, if you look at the household survey, you've taken out over 1 million, full-time jobs in the last few months. So it is kind of happening in the background. So it's to your point, these things are all sort of interlinked. It's going to be a question of how do they come together. I think if you're in a strong economy, it becomes less of an issue, right? If the economy really starts to slow, then companies really need to make a very hard decision about margins versus labor versus revenues. And that's why I say that's kind of your, let's call it 1 to 2 quarter out issue that I think the market's going to have to get through.
For now, things are okay, apparently. Stuart Kaiser of Citi is going to be sticking with us. Inflation data is about 18 minutes away. These are the numbers we're looking for in our survey. The median estimate, headline month-over-month, 0.4 versus a previous number of 0.3. Stripping out food and energy, we're looking for 0.3. Previous number in the previous month, 0.4. That data just around the corner, 8:30 Eastern Time. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. Southwest and Boeing are sliding in pre-market trading. This after Southwest said it will have to cut capacity and adjust schedules due to continued challenges and a drop in deliveries from Boeing. Southwest also sees job cuts by year end, in addition to a hiring freeze for pilots, flight attendants, and other workers. The FDA has approved weight loss drug Wegovy for heart disease patients, a move that could open the door for Medicare coverage. The Centers for Medicare and Medicaid Services confirmed it is reviewing the FDA's action and whether it will cover the treatment. About a third of state Medicaid programs are already covering Wegovy and other GLP-1 drugs for weight loss. Last summer, former President Donald Trump asked billionaire Elon Musk if he would like to buy Truth Social. The Washington Post reporting Musk declined the offer, but it reveals yet another high-profile discussion between the two. Earlier this month, Trump and Musk met in Florida as the former president lines up donors for the general election. Musk took to his social media company X to say he is not donating money to either candidate for U.S. president. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, inflation data about 15 minutes away.
You might get a little bit of a stronger than expected inflation number today, but I'm not extrapolating that out to being we're heading back to where we were. This is extremely problematic.
That conversation coming up next, live from New York City this morning. Good morning. Pause. There's some things that happen in commercial breaks. Sometimes I try and move on quickly, don't talk about it, just to save Bramo from herself. But on this occasion, you have to repeat what you just said. Well, what are you looking forward to?
The Oprah special. It's called Shame, Blame, and the Weight Loss Revolution on March 18th. And the reason why is because he's going to talk about her use of weight loss drugs and give the whole case for them at a time where this is actually one of the revolutions in markets, too. So it's a market story, and that's why I'm watching the Oprah special. So sort of get long GLP-1s the day after the special. I mean, I don't know, maybe get short Weight Watchers, which is, I think, what a lot of people are doing. But this is really a key question. She's going to host a sit-down, informational, and revealing discussion about shame, blame, and the weight loss revolution.
I thought it was important that we shared that moment. We'll pick up on that story in just a moment. Equity futures right now on the S&P 500, positive by 0.2%. Under surveillance this morning, inflation data just around a corner.
You might get a little bit of a stronger than expected inflation number today, but I'm not extrapolating that out to being we're heading back to where we were. This is extremely problematic. It seems like every cycle we go through, there's another head fake on inflation. Ultimately, the lagged effects of policy tightening start to hit. If you get a couple of unexpectedly strong inflation numbers, well, that'll be a catalyst for some type of pullback.
Here's the latest. February CPI 13 minutes away. With the headline month-over-month figure expected to accelerate, the Bloomberg economics team saying this: ultimately, we don't expect the February CPI report to provide clear enough evidence of disinflation to boost the Fed's confidence to cut rates. Michael McKee, our economics and policy correspondent, with us around a table. Mike McKee, what are you looking for in about 12 minutes' time?
Well, we're looking for some upside surprises. That seems to be the general consensus on Wall Street, that on a year-over-year basis, we see CPI go down because of base effects, but on a month-over-month basis, it might come in hot again. And the real focus for everybody who follows this stuff is housing, because we had a big divergence between owner's equivalent rent, which is what the BLS uses to figure out, we've done this before, of housing prices, and rent. And there was a whole kerfuffle over that. So we'll see what kind of numbers we get in housing and then what might surprise underneath. Now, Lisa has given me something to work with here, because you remember the refrigerator, when she bought her refrigerator, that went on for weeks. We checked prices, we checked,
and they were going down.
Prescription drugs are in the CPI, so we're going to check and see.
Are you trying to say that I'm next going on my weight loss revolution?
No, but you brought it up with Oprah, so it gives us something to talk about.
I don't want anything to do with this, Mike McKee. I want to talk about the disinflationary trends. The confidence of this Federal Reserve wasn't derailed by what we heard at the start of the year, even with that blowout payrolls report in January too. Why do you think that was, Mike?
The Fed is looking longer term than the markets. The markets are looking right. Here's what's today, and we try to extrapolate what that's going to mean. The Fed is like, we'll wait until we have to make a decision, and we'll take a look at where we are. Now, there is going to be a question of whether Jay Powell was too optimistic at his Humphrey Hawkins questioning, because he said, we feel like we're getting close here. If CPI comes in hotter than expected, then that's going to not look so good. Now, nobody was expecting them to do anything in March, but we do have a new summary of economic projections, and we have a new dot plot. And so if we get a hot number, that could influence some of the members and change the dot plot a little bit.
That's where actually exactly where I was going to go, because Stuart Kaiser here from Citi has been talking about how this is an incredibly important CPI print, that basically this will be definitive for markets on some level to figure out whether January was just a blip or not. I don't have a sense of how flexible some of the Fed committee members really are at this point to one print, right? Are they kind of going with the assumption that disinflation will continue even if it's bumpy, and that the risk right now is potentially more to the downside for the economy than really to the upside with inflation?
I think they're thinking it's about 50-50 for the economy. What they will do is parse these numbers closely, because there are seasonal effects in here. In January, February, prices tend to go up more because it's the beginning of the year. They have to take those out of the equation and figure out whether what they see is a lasting jump or not. And the dot plot is basically going to be looking at this year. So if you have a hot first quarter, it might push things out farther, and maybe you end up with fewer cuts just because you run out of time. That's kind of where the Fed is going to be looking at this, whereas the markets are going to be looking at this and going, oh, my goodness, we have inflation. Let's push down some bond prices and push up some bond yields and see what we get out of it.
Mike, you framed this perfectly. Stu, going into next week, I think a lot of people on the street, including Andrew Holmhorst of Citi, your compatriot over at Citigroup, basically is looking for the SEP to remain unchanged. Is there anything about what happens at 8:30 that could bring that Federal Reserve meeting alive a little bit more?
I mean, I think it'll start the discussion in markets if we round to 0.4 or above. I mean, I think it only takes 2 committee members to raise their dot to go from 3 cuts to 2. So it's a relatively low bar to get there. Again, this is not the base case. Andrew is by far more intelligent on this than we are. But I think from a market's perspective, if you print it hot, the market has to at least adjust what the probability distribution is. It's okay to try to ignore one and call it seasonal. If you get them back to back, I think if you're being intellectually honest about that, you have to respect the fact that those two things happen. I think Mike used the right word, kerfuffle, which is like a fun word for argument, and I think we'll kind of get that kind of situation if we get a strong print.
I'll use another word that Jamie Dimon used because he likes to do weather reports, but he talked about the potential for stagflation. And at what point do we get inflation that's not accompanied with the strength enough to call it just a hot market anymore?
Yeah, and that's why we're so focused on the jobs market. I mean, I think the equity market is willing to tolerate a lot of stuff as long as that labor market remains strong and GDP growth remains kind of strong. We're talking about stagflation. I think what you're kind of saying is inflation is going to be persistently high. So I think that almost means you're stuck at a level, let's call it between 2.5 and 3.5, that is above what the Fed would otherwise like. And the growth is slowing or is kind of below trend alongside that because of the kind of a give back from maybe all the fiscal spend and stuff we've had. So to me, stagflation that's something that has to play out over a number of quarters or months as opposed to something you're going to see in like one data print.
I have to go there with the artificial intelligence talk and the weight loss drugs. Is this inflationary or deflationary, sort of in the short and the long terms?
GLP-1 and AI. I think the market is probably thinking of these as more deflationary trends, i.e. AI kind of works against wage growth, and GLP-1 theoretically gets you more labor force participation and reduces spending on healthcare. So if you're being optimistic, that's how you would put it.
Seriously, that people are actually gaming out that it increases labor force participation?
100%, yeah.
Because people lose weight, but they're also healthier and they're able not to miss to go to certain kinds of medical treatments. Is that the idea?
And they're less happy, so they don't mind, just going to work. But Mike can comment on that better.
The weight loss stuff, it's not just weight loss. The scientists see a lot of potential uses for these GLP-1s. So there could be a lot of health problems that would be taken care of that then people could go back to work. The interesting thing about it is you're going to get probably a deflationary impulse from those drugs as they get approved by the FDA for other uses, because then insurance companies will be taking over the payments. It'll show up more in the PCE and the PPI, but it will reduce the price of it on a monthly basis, which would be a short-term win for CPI.
How do you price a story like that? We can all sit here and talk about the revolutionary potential of a drug. How on earth do you come up with a fair PE, a multiple, to put on companies like that?
It's extremely difficult because a lot of companies have this drug, right? There's just a number of them that have caught the bid, so to speak. But I think the issue here is you look at total healthcare spending in the U.S. and you try to model out how much it could kind of erode that, and how many people do you think are not in the workforce because of this? It's a layer of assumptions. So,
what do you think? Can I just ask you this in the context of a broader portfolio? Has healthcare and the position in it as a portfolio manager shifted, just the characteristics of healthcare? Because when people come on the programme, they used to talk about healthcare as just a defensive way of maintaining some kind of allocation to equities. Now it feels like pretty constructive, optimistic, super aggressive ways of positioning for a completely different world.
Yeah, I mean, we like healthcare as a trade to the long side from a sector perspective for exactly the reasons you described. It's more defensive. It actually has a positive beta to inflation right now. So if you got that kind of risk-off thing that Lisa's been describing, it should hold in well. It's going to grow EPS about 15% this year, and you've got GLP-1 as a theme. So the view is if the market rallies, it can kind of keep up because it has enough growth to do that. So, yeah, we're pretty positive on it. Look, both these themes, AI, GLP-1, have become more than single stock themes. Their earnings, their PE, but they're also GDP growth and inflation. People are talking themselves into these just being like collectively large themes, which is why we have to talk about it.
Mega themes. Stuart, good to see you. Stuart Kaiser, a Citi, alongside Mike McKee. Mike McKee's going to stick with us. He's going to break down the inflation data in just a moment. Reacting to that, fantastic panel for you. Mizuho's Steve Ricciuto on why he thinks we're getting no rate cuts in 2024. We'll get his reaction to the economic data together with JP Morgan's David Kelly. Plenty of price action just around the corner. The biggest data point of the week stateside, maybe even worldwide, is coming up next. US inflation data just around the corner. The scores going into that information look like this. On the S&P 500, negative, or rather positive, by 0.2%. On the Nasdaq 100, up by 0.5%. In the bond market, 2-year, 10-year, 30-year, shaping up as follows. Yields lower, negative by 2 basis points on a 10-year, 4.08%. On a 2-year, 4.53. With your economic data, CPI in America, Mike McKee has the numbers.
Let's play hot or not, and it does look like we are hot because CPI comes in on a month-over-month basis up 0.4. Core comes in up 0.4. The forecast was for a 0.3 rise, pushes up the year-over-year CPI to 3.2%. Now, that is probably energy-related, gasoline price-related, but we will check the numbers as they come in. But the core rises, or actually comes down to 3.8 from 3.9, but that's above the 3.7 consensus. So at this point, it looks like we have a little bit stronger core numbers than anticipated, and we'll just have to look and see where that inflation came from.
Looking for a bigger shift lower in core, did not get it. Equities look like this on the S&P 500, pulling back just a touch. They were positive going into the print by about 0.25%. Now just about unchanged on the S&P 500. We're positive still by about 0.2% on the Nasdaq 100. A clearer move in the bond market. Yields were coming in a couple of basis points on a 10-year, now up a single basis point to 4.1%. These aren't major moves, up about 2 basis points to 4.55, 4.56 on a 2-year. You have to think about where we were 2 Mondays ago, through 4.70 at the front end of the curve. So yields have come down a lot since then, and they're only up by about 3 basis points right now. So yields higher, dollar stronger, the euro dropping back to about 109.20. And looking at this economic data again, we were looking for 0.4 headline month over month. That's what we got. We were looking for 0.3 on core, stripping out food and energy. We didn't get it. We got a hotter Michael McKee, 0.4%. When you look beneath the surface, Mike, what do you see?
Well, the headline number is probably energy driven. We saw gasoline prices for the month up 3.8%. They fell 3.3% in the month of January. So big difference there. Food, everybody keeps an eye on food prices because we all got to pay that. And for the month, we saw food prices flat, which is a bit of a surprise. There was an expectation they might rise some. But I think in the core, the two biggest things that affected the core were used cars. They were up for the month by 0.5%, which is in contrast to the 3.4% they declined in January. So a big change there. And then what we're seeing for owner's equivalent rent is that we have seen that come down a little bit. It's up 0.4 compared to 0.4 for rent. So the divergence that we saw in January has gone away. I'll look for some other big movers, but it looks like used cars played a big role, energy played a big role, and food did not, which is a bit of a surprise.
I'm struck by the market move right now. I'm just watching as people shrug this off, essentially. You're seeing two-year yields reverse a lot of the earlier move. And I'm looking at this and trying to figure out why, Mike, because right now we're seeing the inflation surprise comes from a different place every month. Last month it was OER. It was owner's potential equivalent of rent. Now we're looking at used cars. Why isn't this being viewed, at least by the market? Can you figure out as something that is stickier and multifaceted versus just simply noise on the disinflationary trend downward?
Well, that may be why, because we're seeing a lot of things go up one month, down the next month. And so it's not a consistent pattern of inflation in any particular area. And since you have that, it may be noise. You don't know. Some of these things are pretty volatile. I'm looking for airline fares, which I haven't come across immediately yet because I've got this whole long thing to look for. But that's a good example of things that go up and down on a regular basis. And that's the kind of thing that tells you it's not something that can't be gotten rid of or won't change as we go forward, that sticky would be the word.
Mike McKee, let's go through those numbers again. And this is what we got then, 0.4%. The estimate was 0.4%. That's headline, month over month. Core, stripping out food and energy, 0.4% the number. The estimate, 0.3%. So a touch hotter than anticipated. Though as Mike broke this down, what jumped out to me was the Shelter Index, Mike McKee, just not as bad as it was in the previous month. And I wonder, to some extent, and I hate to mark these comments to market, but we are accelerating again in the equity market, so it's probably worth asking this question, whether we can take comfort from that the shelter pricing story didn't run away this month like it did in the previous one.
Oh, I think you can, and I think the Fed will. There was concern because OER went up, and then we had this whole kerfuffle, as we mentioned earlier, about the weighting of single-family houses in the index that the BLS had to explain, and we got half the economists saying it didn't mean anything and half said it did mean something. But right now it doesn't matter because they came back down to 0.4. Now, the Fed is hoping they continue to decline, that rent prices and home prices continue to decline, because that's what's supposed to happen. And if that's the case, then we'll see a little bit better numbers going forward, and they can take a little comfort in that.
This stock market is turning around pretty quickly, as Lisa identified. We were lower initially, then just about unchanged. Then a few minutes later, we're positive by 1/3% on the S&P, up by 0.6% on the Nasdaq. The move on yields fading just a touch, still higher by about a basis point across the curve, the 2-year out to the 30-year. In the FX market, the euro just about unchanged against the dollar, 109.26. Fantastic panel for you. Steve Risciuto of Mizuho, David Kelly of JP Morgan Asset Management alongside us. David, first to you, your view on this inflation data of the last 5 minutes or so.
Yeah, I think it's okay. There are some bouncy numbers here. We've got a 3.6% increase in airline fares. That contributed to it. We got a 0.6 increase in apparel, which was down 0.7 the prior month. So it's bouncing around. But I think the big picture here is it's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly. And you want that inflation rate to come down faster. And it is coming down, but it's going to take some time, and that's okay. But I don't think there's anything here to alarm the Fed or anybody else. Some of the things that bounce month to month bounced higher in February, and that's why you got this number.
David, just to extend this one step further, is eating the cookie cutting interest rates? Is that what that is?
Yeah, but it's probably, too many cookies are not good for you. So I'm not looking for a very fast reduction in interest rates, and that's okay. I just want to see this expansion stretch out, and if the inflation rate can slowly cool, that's really the best for the economy and for investors.
There's a question, just to continue the analogy, Steve Risciuto. If you leave the pan of cookies on the oven and the oven is still on, do they cool at all? And that is really a key question, essentially, if we're dealing with a lot of these different factors that still are sticky and going and coming. But if you don't have some sort of ongoing tight policy, do they cool at all?
Well, the reality, fundamentally, it all comes down to the labor market at the end of the day. I hate to bring it back to last week's economic statistics, but it really does. The results is that most of the components in inflation that are not going down are components that are service-related, therefore they're income-based, and that's an important driver. And as long as we have an economy that is running with this tight a labor market, and 3.9% up from 3.7, oh, that sounds like a really big move. It's really not a big move. We're still well below the natural rate of unemployment, which means the frictional level of unemployment in the economy. This is a tight labor market, and it's not generating the easing of the labor market conditions that could say to you, inflation's definitely going to go back to 2%. And I think at the end of the day, the reason why you have a market that's looking through this number that came in hotter than expected is because the Fed's telling you they want to cut rates. So they're not telling you, well, we're looking to see whether we have to raise rates or we have to cut rates. They're telling you we want to cut rates. The problem is the data is not letting them. And this has been the driving force behind our call all year. And we began it last year in November that they probably weren't going to be given the opportunity in 2024 because the economy is not going to give them the opportunity. And that continues to be the underlying thought process here. And this data just kind of pans it out.
This is what makes your call really, really compelling. As you say, you are fighting the Federal Reserve.
Well, I'm not. The Federal Reserve is fighting the economy. That's the difference. I'm not fighting the Fed. I'm not fighting the economy. They're fighting the economy. And I hate to tell you, fighting the American consumer is a losing battle. And that's what we're running into. This American consumer, they have a tight labor market, they have income gains, and they're going to spend it. There's liquidity. People are willing to lend the money. They're going to spend money. And that's the Energizer bunny of the U.S. economy, is the U.S. consumer.
David, I heard your voice as you tried to interject, so go for it.
Well, yeah, with all due respect, I do slightly disagree with this whole idea that we're getting inflation coming or significant inflation coming out of the labor market. It is still a tight labor market, yes. But even in this report today, one of the key variables I look at is food away from home. What are restaurant meals doing? Because that is very sensitive to wages, and they were only up 0.1%. Also, if you look at last Friday, look at the labor market data in general, the quits rate is now down to 2019 levels. So people are not quitting in huge numbers. If you look at the National Federation of Independent Business survey of owners, the number of people number of small businesses that say they're going to raise wages is now at its lowest level since March of 2021. So we're not seeing those wage increases. Yes, it's a tight labor market, but we've got a lot of low wage immigrants coming into the labor market, which I think are holding that wage growth down. And I don't see a spread of wages in this report. What I see is auto insurance up 20.6% still. That's pushing up the measured CPI inflation rate. We've got shelter costs up 6% year over year still. That's pushing up the measured CPI inflation rate. But both of those numbers are lacking reality. And so what I think is going to happen over the course of this year is, yes, inflation is going to come down slowly. And I think that's fast. I think that will be fast enough for the Fed to start cutting in June, because we still do have a demonstrably tight monetary policy given the direction of inflation, and we ought to try to move back to neutral.
Steve?
Yeah, well, I think when we go in and start looking at individual components of an index, we're making huge mistakes. This is the point I think Lisa was talking about earlier. This is an index. It has components that are going to move up and components that are going to move down. That's why we use an index. That's why we just don't look at individual components. We look at the broad index. And the broad index is telling you a message. Inflation's sticky. We can argue and say, oh, this month this did this month this did this. But the reality of the situation is the index is not doing what they want it to do. So general price movements aren't doing what they want to do. And they're doing it because of the labor market. And this concept about the quit rates and everything else, we don't have enough historical data of the JOLTS data to make any really valid statistical commentary off the JOLTS data. It doesn't exist far enough back. And we're jumping on these new Vell statistics just like we did during COVID when we were looking at all these things about, how many people were booking restaurants, how many people were going to, taking out a DoorDash and things like that. And they all led us absolutely nowhere. The reality is the index is not going down anymore. It's stalling out. The core numbers seem to be leveling out as well. That's telling us that we still have a tight labor market. And on average, that labor market is generating enough consumer activity to keep this economy going and to keep inflation from coming back to the Fed's target as quickly as they would like it to be, because they're promising to cut rates. And the reality is the economy's not giving them the opportunity. And that's the real driving point.
David Kelly, I'm sure you want to jump back in.
Well, yeah, I do think, even with the JOLTS data, I mean, we've got a lot of data. You do have to put together a mosaic of all of these data. I do think it's a mistake to use sort of rules of thumb or how the economy would have operated 20 or 30 or 40 years ago. The truth is, this is not your grandfather's economy. It is not inflation prone. Inflation went up a lot. It's coming down. And even on, looking beneath the surface in the index, I agree if these were small categories. But that auto insurance issue is adding 0.6% to the overall CPI inflation rate, which, we would be at a 2.6 instead of a 3.2 if it wasn't for the auto insurance issue. And again, the shelter issue is also actually more than 50% of the year-over-year inflation rate. So these two things, the way the government is mismeasuring shelter and the way it's mismeasuring auto insurance, if those two things fall out gradually of the CPI numbers over the course of this year, that CPI inflation rate will move down towards 2% unless we have an energy shock. So I think we're still, I still think it's cooling. I think somebody shut the oven off. These cookies are cooling. They're just cooling slowly.
Well, let me just deal with the auto insurance issue, because one of the reasons why auto insurance rates are going up is because when you get a fender bender today, it's awfully expensive to repair the car. Okay, there's a lot more in fenders these days than there used to be in fenders. So the reality is the costs are measuring what's in reality happening. It's not a spurious uptick. That's number one. Number two, when people get into arguing about, oh, the rent to shelter doesn't do this or it doesn't do that, the reality is this is the index we have. Let's not talking about, oh, gee, can I get a perfect index? This is the index we have. This is the index we're setting policy on. This is the message that's coming across. The BLS does a very good job at trying to measure these things and measuring them as accurately as possible. And I think all of this second guessing as to what the data is doing undermines the real reality of the situation and keeps people hoping for something that's not happening. This is exactly what the Federal Reserve wants to have happen. They want everybody to keep on hoping that it's going to happen, so it keeps markets in, it keeps the labor market tight, and they hope they get an increase in social welfare. And that's what I think is the driving motivation behind this. And that's the reason why the equity market is up. Let's be honest. You have an economy here where the Federal Reserve is saying, we're not going to upset the apple cart. We're going to keep this economy moving. We're going to keep it going in a forward direction, and that's good for stocks. So it's no surprise to me that the equity market's doing what it's doing. Yep. The corollary is the bond market, on the other hand, is taking the assumption that we're going to get back to 2% inflation. And when people say, oh, this isn't your grandfather's economy or whatever, and we're not getting back to double-digit inflation, the reality is if we're talking a big difference between 2% and 3% inflation, we're talking 100 basis points on the 10-year note. That's huge. And therefore, we can't discount the fact that we're getting stuck around 3, not around 2.
As you speak, equity's doing nicely, up by 0.6% on the S&P. We'll continue this conversation. Steve Rizzuto of Mizuho alongside us, together with David Kelly at JP Morgan Asset Management. Steve basically saying no rate cuts in 2024. David Kelly is basically saying the Federal Reserve should get out of the way. Inflation's coming back down. The conversation continues up next.
Last year was the year of cash. All of a sudden, a lot of these savers who were coming off the sidelines realized I have to do more than have my money sit in a bank account.
US inflation numbers out just moments ago. Core inflation topping estimates for a second consecutive month with a very different outcome in this equity market. Equity futures are positive by 0.6% on the S&P 500. Yields are lower by a single basis point on a 10-year, 4.08%. And the euro is stronger. At least the dollar's weaker. Euro dollar right now, 109.37.
Which is confounding to me. And it goes to this question, is it the David Kelly version of things, which is essentially that this is just a bumpy road down to 2%? Or is it a Steve Rizzuto form of things where nobody wants to fight the Fed and the Fed wants to cut rates? And frankly, that's what they're going to do. And that's going to support things no matter what. And nothing in these numbers is strong enough to derail that.
David Kelly and Steve Rizzuto with us right now. David Kelly, let's talk about the Federal Reserve. Governor Waller, what's the rush? President Kashkari, why do anything? You've got an answer to that. David, what is the answer?
Well, I think the answer is, to be honest, the Federal Reserve should not be trying to micromanage aggregate demand in the economy. If we've got a federal funds rate between 5.25% and 5.5%, that is a tight policy. It is designed to slow the economy down. It can cause, it's given us an inverted yield curve. It's causing problems in the pricing of assets and in regional banks. I don't want the Fed to cut aggressively, but I think they should gradually move back to neutral if the inflation rate is heading towards 2%. And so I think they'd be right to start in June, cut again in September, cut again in December, take it easy, but bring rates back down to a neutral level, which I regard as being somewhere in the 3.5% to 4% range for the federal funds rate. But they ought to do that because there's no reason for them to be interfering with the economy, which is actually going in the right direction with inflation, in fact, heading towards where they wanted to go. And on the issue of auto insurance, I realize that auto insurance prices have gone up. I have to pay higher auto insurance too. My real issue is it's up 20.6% year over year now. And whether the government is measuring that wrong or correctly or incorrectly, I'd be willing to put money on the table that it won't be up 20.6% a year from now. In fact, I wouldn't think it'd be up as half as much as that. So if it comes down over the course of this year, it's going to pull the CPI inflation rate down. So I do think that inflation is coming down. And if the economy is moving in the right direction, the Federal Reserve shouldn't have its hand on the tiller either way. That's why they should move back to neutral. Which raises this question, David. And before we go to Steve, I am curious, though, about the oven and the cookies, just because there is the sense that if you have easier financial conditions, as we see today in the market on the heels of a hotter than expected CPI print, that this will actually keep these multifaceted areas, continue to make them hot. Basically, the wall of money isn't going away because real wages are actually increasing. How do you fight against that idea? Because we've had, for years, we've had an economy which before the pandemic, before we had all this fiscal policy, we had an economy which was quite capable of producing low inflation. You know, yes, it's a tight labor market, but I mean, how many major strikes do we have occurring right now in the United States today? I think the answer is zero. I mean, we're not seeing a very vigorous labor force demanding high wage increases to, or they'll quit. And so I think you can actually run this economy relatively strong at high levels of capacity without generating higher inflation. And what's wrong with that? So I do think this is not an inflationary economy at its core. We got inflation because of the pandemic, the policy response in Ukraine. That's fading and has really faded. And because of that, I think inflation comes back down to 2% anyway. This is fascinating, Steve, because ultimately this is one of the big disagreements. Are we entering a new normal, or is this going back to the old? I mean, is that essentially the breach between yourself and David Kelly?
Well, there's this concept that because we were there before COVID, we're going to go back to there. Okay, it's a simple argument. The reality of the situation is the world we had before COVID had two very big differences. One, Larry Summers was talking about secular stagnation. Okay, which clearly was not correct. Alan Blanchard, on the other hand, I think was 100% correct, talking about the fact that we had a debt overhang. Well, COVID corrected that debt overhang, okay? The federal government bailed out all the state and local governments. The lower interest rates allowed everybody to refund all or refi all of their mortgages and all their corporate debt at much lower levels of interest rates. Interest expenses are actually no problem for corporate America. That's a big difference there as well. The other fundamental difference that's taking place is before COVID, people were uncertain in their jobs. Okay? There was a high degree of uncertainty in employment. People were always convinced this whole concept of double-digit earnings, corporations making sure they managed towards earnings was going to bring down their employment. They could get fired any moment. Now there's a lot more security in your job. And when there's a lot more security in your job, it doesn't mean we're going to get accelerating inflation. The question is, does inflation come back from 3 to 2? There's a big difference between the two of them. And the big difference is not necessarily an equity consideration. It's a bond market consideration. Because fundamentally, where should the 10-year note be? The 10-year note should take the inflation target, or the long-term outlook for inflation, and add the underlying trend rate of growth to the economy. So if you have 2% inflation, you should have a 10-year trading range of 3.75 to 4.25. We're basically in the middle of that range right now. If it's 3% inflation, then it's 4.75 and 5.25. We're nowhere near that range. And this is the fundamental difference. And this is the problem for the Federal Reserve. They have a 2% target. They don't have a 3% target. They have a 2% target. Now, markets right now are allowing them to continue to be patient. At some point, the markets may say, we're not going to allow you to be patient. And that becomes the concern. When the bond market begins to turn around on them and say, you know what, we're not dealing with this, that you're going to get back to 2% inflation. That's the risk if they move. If they move and you wind up seeing the dollar go down dramatically, you could reverse a lot of the goods inflation, disinflation that has been taking place. And if that happens, they then have an inflation problem on their hands. And this is why they have to be patient, and they're probably going to have to be patient throughout the balance of this year. But it's not a negative equity story, because this Fed does not want to set this economy back. It's a positive equity story, and that's what's happening in equities. My consideration is the yield curve could stay inverted a lot longer. And just because the yield curve's inverted doesn't mean it's a problem for the economy, because nobody borrows at the front end of the curve anymore like they used to. And that's a critical differentiation.
You're asking a balance of risk question around the Federal Reserve, and I think it's an important question. David, help us answer it. The biggest risk right now, is it cutting too soon or holding too long? And why do you still believe it's holding too long?
Well, I don't think the biggest risk to the economy is actually the behavior of the Federal Reserve. I think they should, as a matter of long-term strategic policy, move back to a neutral rate because the economy doesn't need them to be tight at this point. But the bigger risks to the economy are really from outside of the behavior of the Federal Reserve anyway. Geopolitical risks, environmental risks. If something happens to oil, then our entire view of the world sort of changes a bit here. So I think the Fed ought to begin to cut. I think they will begin to cut. But my main point is that as we look at the data month by month, category by category. Now, we do build up to the pieces of the index because that's how we forecast. We have to look at the individual pieces. And what I see is a global economy, which is relatively sluggish. China is sluggish. Europe is sluggish. It's not generating enough demand to push up core goods or even food and energy in any way. So without some supply shock there, the whole goods part of the global economy is not going to give you inflation. I don't see a labor market that is particularly inflationary either. And so that allows you to come down to 2%.
Let's agree on one thing. We do this again next month. David Kelly, Steve Risciuto, to the two of you, thank you. Inflation data just a little bit hotter in the equity market. The green light is still on, apparently, to carry on rallying. The S&P 500 positive, 0.4%. Big day to follow up tomorrow. Looking forward to that coverage from New York City. This was Bloomberg Surveillance.